Good morning and welcome. My name is Jeff Wilson and I'm Chair of and Founder of Wilson Asset Management. Look, thank you very much for coming here today. When I saw the little 25 years up there, I cast my mind back and there's a number of regular faces here, but I think one of the first ones, these get-togethers we had up in Macquarie Street at the History House, and I think it cost us $60 for the morning to rent it out, and I think we had 10 or 12 people. Things have grown over time, and thank you for supporting what we're trying to achieve in terms of managing your money. And today, well, actually, before I start off, I'd like to begin by acknowledging traditional owners of the land on which we meet today. That's the Gadigal people of the Eora Nation, and pay my respects to elders past and present. In terms of the format today, I'll give a little bit of introduction and I'll talk to you about what's really on my mind at the moment, and that's some legislation that the government's proposing on franking credits. Then I'll pass to Kate, our CEO, and then we'll go to the panel session with the lead PMs and have question and answer, and then open it up for you guys for questions and answers. In terms of the reason, and you'll see on your chairs, there's various signs or placards that we'll ask you to hold up a little later. And the reason for that, and they're all to do with the proposed franking legislation that the government's, that's in front of the Senate at the moment, and there's actually a Senate inquiry going on. Next Tuesday, in a week's time, there's hearings, which will be up here in Sydney, which we'll be presenting at the hearings. And we hope that sanity prevails. Now, we all saw back in 2018, 2019, an illogical franking proposal by Labor, and yourselves, your children and your grandchildren all sent them a clear message back then. Again, unfortunately, we need to send a clear message to the government at the moment. And probably it's twofold. One is don't break election promises, and the second one is keep your hands off our franking credits. And the government, well, if they don't understand, they should understand how important Keating, what Keating and Hawke brought in is a system that encourages Australian companies to invest in Australia, to pay tax in Australia, to employ Australians, to pay fully franked dividends to shareholders, to reduce the amount of capital that they have to raise, to reduce their cost of capital, and to encourage them to raise capital and not have debt. And that's why we've had over 3 decades of uninterrupted economic growth. And one of the reasons is the franking system. And unfortunately, what's happening now is we've got a situation where the government there's two bits of legislation that's before the Senate at the moment. One is to do with off-market buybacks, and that's going to raise $550 million over the forward estimates. Now, that one, even though it's probably, you should let a company do what it wants with its assets, we accept that the budget needs repair, and we're not arguing against that. There's just one paragraph they've got to change. It's unfair in that. But broadly, we accept that part of the legislation goes through. Chapter 5, unfortunately, that's where what that one is, and that's the one that we're really very strong that it's got to be knocked out, is that's when a company, if a company raises $1 of capital any time, and that $1 of capital is associated with them paying a fully franked dividend, then that fully franked dividend is unfranked. Now, it could be 10 years ago, or it could be in 10 years' time. There's no time limit on that. And from our perspective, that is just totally unfair. I just don't know if the government isn't that smart, or the people in Treasury aren't, or you've got a situation. I think Treasury are very smart, and they've pulled the wool over the government's eyes. That's what worries me with that legislation, because the Treasury always talks about the first impact. They don't talk about the secondary and the third impacts of these types of legislation. The first impact is they're going to save $10 million a year, that's all. But what is that legislation going to do? It is actually going to stop, there's 2.5 million small companies in Australia. It is going to stop the small companies. You've got a small company that makes $10 million pre-tax, pays its $3 million tax. It's been losing money for the last 10 years, finally makes some money, has got $7 million. It can't afford to pay that out to shareholders as a fully franked dividend. It needs that capital to keep growing. So what they normally do is they raise money, say at $140 million valuation, raise $10 or $20 million, and then that allows them to pay that fully franked dividend. Unfortunately, that can't happen under this new legislation. So all those small growth companies in Australia are going to be crippled by this legislation. Secondly, you've got the large companies that have got a lot of franking, and we've seen it with Telstra have done these buybacks. The banks, there's BHP, all these buybacks. There's a lot of mature companies that have a lot of franking. So probably the benefit for you as investors is if they can't do those off-market buybacks anymore, you're probably, in the short term, you're going to get more franking. The problem is for your children and your children's children, in the long term, they're going to be significantly disadvantaged, because those large companies that have that excess franking, they're going to focus on not paying tax in Australia. You're encouraging the smartest people in Australia to focus on minimising their tax. Or they'll invest overseas. Like BHP tomorrow could pay a $30 billion fully franked dividend. So if they can't do those buybacks anymore, when they look at it, the best way of getting a return, maybe it's invest overseas. Don't invest in Australia and pay tax in Australia, because the benefit is gone. And we think that'll cost the budget at least $1 billion a year in terms of those large companies focusing on tax minimisation. So from our perspective, it is just, please be as vocal as you can. And actually, why don't we, and let's hope that the government does understand the unintended consequences, and let's hope that this Senate inquiry really does what it should do and bring that to light. Why don't we do, we'll just take a quick picture now, because that's my spiel. Can everyone stand up? Or can you grab your little, the signs? So, we'll give some, okay, we got signs at the front pretty much. So, you're going to have a few biggies. Okay. So where do you want us? Well, I'm here, more here. Well, and I'll go down, but we'll do an up and down, or? Okay, I'll go in. Yep, okay. Where's the big, okay. Here we. Higher, okay, beautiful. Beautiful. Okay. No, thank you guys. And now, obviously that was a serious part. Kate's still got the serious part. Now I'd like to, oh, okay. Sorry, we want the, oh no, actually I prefer, I'll hold them both. Yeah, okay, there we are. I know these are the ones, I'm not sure if they voted for these or not. Oh, sorry, we're all up again. Hey, at least it'll, I know Anthony Robbins says, get everyone to stand up, get people to stand up every 20 minutes. So, sorry, we might be a little bit over that. Great. Thank you. Now, I'd like to pass over to our CEO, Kate Thorley. Thank you, Kate.
Thanks, Jeff. Looking very serious in that photo. And good morning, everyone, and welcome. Just to start with, you saw the disclaimer there. So just to remind everyone that Jeff mentioned we've got 3 panels, 2 this morning and 1 straight after lunch. And those panel discussions are general in nature. We're not taking into account your personal financial situation. So please bear that in mind. But thank you all so much for being here. A big part of our purpose at Wilson Asset Management is to make a difference for you as our shareholders. And just on behalf of all the team and Jeff and myself, I'd like to thank you for coming along, because we're managing your capital. These are your listed investment companies, and the team and I absolutely love going around the country and meeting with so many of you to answer your questions, report back in how we're going. It has been a really tough time in the market, and that's, it's so important that you know who it is that's managing your money, and that we show up regularly to report back and answer any questions that you have. And as Jeff said, there's, the whole team from Wilson Asset Management and Future Generation are here today. We've all got our name badges on, and we, as I said, we all love meeting shareholders and engaging with you. It is such a big part of our DNA. And also, you've got these feedback forms which have a rating of 1 to 7, 1 being the highest. If you can also take the time to fill these in later on at the end of today and hand them back to a member of staff. Your feedback is just so important to us, and we do love hearing from you. So over the course of the last few months, we've been speaking to a lot of shareholders. We've been ringing you about the WAM Leaders Share Purchase Plan to answer any questions that you may have. We also like to speak to shareholders around the time that we do results and our fully franked dividend announcements. And a lot of you have been telling us that you're really concerned about the current economic environment. You've been concerned about the pace at which interest rates have been rising more recently. You're worried about, potential changes to laws around your superannuation and what that's going to mean for your retirement savings, and what it means, the impact that could have on your families, and also things like the cost of living. And so hopefully today, the team and I will be able to address some of those concerns and also outline some investment insights and opportunities. We were on the Sunshine Coast and in Canberra earlier this week and late last week, and to me, hearing from the investment team, it's in times of great uncertainty that they see, real opportunities. So hopefully they can, share some of that with you this morning. So with that, thanks again for being here, and I'm going to invite Jeff and our portfolio managers back up on stage. We have Matt Haupt, who manages WAM Leaders, which is the large cap portfolio. Dania Zinarova, who manages WAM Alternative Assets. Katrina Burns, who is here from New York. She manages the WAM Global portfolio. And Oscar Oberg, who is our lead portfolio manager for the WAM Capital, WAM Research, WAM Active and WAM Microcap portfolios. So thanks, everyone. And I'll hand back over to Jeff. Thank you.
Thanks, Kate. Look, thanks everyone, and I've just the Q&A. I think, why don't we start, just from the global side, looking at the big picture, and then we'll go to leaders, and then do mids and smalls, and then alts. So, Katrina, why don't we start with you? Do you just want to give us a bit of an idea of what you're seeing happening around the world, and yeah, but why don't we start off with that? Just a general flavour.
Sure. So I was reflecting on when we were sitting here a year ago in May 2022 and where the world was at that point. And I think the Ukraine war had kicked off. Inflation in the US, for example, was running close to 9%. And the Fed had started hiking interest rates. As we're sitting here today, we've now had the fastest rise in interest rates in living memory. We've had inflation come down, for example, in the US from that 9% down to around 5%. And what we see is that with rising interest rates, there is a lag in terms of the effect that that has on the underlying economy. And so it has been amazing in terms of the resilience up until this point of the US economy, for example. And actually, it's interesting, even when you look at Europe, we were sitting there as we went through last year, and we had the energy crisis, we had the amazing adaptability of the economy itself to restock in terms of those oil and gas supplies. And we actually sit here today with the market barely off the all-time highs. So it's quite amazing in terms of what we've gone through. For us sitting here today, though, we're sort of reflecting on how much of those interest rates actually fed through into the underlying economies. And we still think that that is still to be seen. And it is interesting when you reflect on the everything bubble for sure has burst. You've seen unprofitable tech companies, for example, in the US fall 60 to 80%. Small caps, where we tend to love to invest, have been hit. But the market overall is sitting, the MSCI World Index is 12% off the highs, which is quite amazing given that enormous run-up in interest rates that we've seen. So as we sit here today, we are cautious in terms of the overall market somewhat, but we look at the companies that we own and we're actually very excited because when we look at the underlying earnings of the companies that we own, we think they've actually really well positioned going forward. We think at the moment you really want to be positioned in resilient growth companies. For us, that's, we've got lots of little niche businesses that we think can continue to grow through this period. But it is very, very much a case of being selective on where you invest because it is, there are various headwinds. I mean, you've seen in that, when I talk about that everything bubble, and particularly in those unprofitable tech companies, for example, you do see as the tide goes out, you have seen things like Silicon Valley Bank, blow up. And that was very much at that more speculative end in terms of their lending practices, in terms of their deposit base. I mean, I've seen stats saying it was 50% of venture capital-backed startups banked with Silicon Valley Bank. So, they had an asset liability mismatch. There's no doubt that when the tide goes out and interest rates have risen so quickly that there are going to be casualties. There will have been misallocation of capital. So there is reason to be cautious, but I think as active fund managers picking individual stocks and looking at the underlying fundamentals, you can find some great opportunities right now.
And I know, just talking about that, and I know, when we were talking the other day, you were saying how, the area, the mids and smalls, you're looking for those undervalued growth companies and buy them when there's a catalyst to change the valuation. That area on a global basis is probably the cheapest it's been for decades, wasn't it? What was that statistic that?
Well, I think the cheapest, there's only been one other time in 37 years it's been this cheap, and it was the dot-com bust. And Oscar had a great stat, on Monday in Canberra. It's been the 10th worst year for small caps since 1926, which is incredible. And that disconnect, historically on a global basis, small mids have tended to trade at a premium to large, and at the moment they're at a 10% discount.
And okay, looking forward the next 12 months, what's your view of what'll happen, or?
Well, our view in terms of is that there will continue, it is likely that we will continue to see other blow-ups potentially because as, a decade plus of very low interest rates is going to have led to misallocation of capital and so there will be other things that blow up and unwind. But I think the point for us is that we can actually see really exciting opportunities, particularly in that small mid-cap area, which has, already been hit. When you see markets volatility, when you see market volatility and sell-offs, small mids tend to get hit, more aggressively early, and then do tend to rally well out the other side. So we are still seeing, we do continue to see, really exciting opportunities. We do think that, we talked about this last year in terms of, I remember Matt we were talking about the phases, that often when interest rates rise, you get that initial phase of valuations being hit, and then it's earnings. And we are still in the midst of going through that earnings downgrade cycle. So, but when we look at the companies, that we hold, we're actually, we have some really exciting opportunities, say, in the healthcare space, which tends to be much more resilient. We see really exciting opportunities in the data space, where and in benefit in things like exchanges, which benefit from volatility, in areas like infrastructure underbuild, where in the US you've just got enormous spend that needs to happen on the grid. So we think we are cautious on the overall market, but we do see really exciting opportunities still.
Great, and before we came in, when we were having coffee, I was talking to a few shareholders, and they were just talking about WAM Global and what great value it is at the moment, trading at an 18% discount to NTA, and I was just taking them through the logic there. It did trade at a discount in the early days. It did trade back up to NTA. It was trading at a premium. Then there was the merger with Templeton Global, doubled the size, and you had a choice, cash or shares. The shares were a bit more attractive, so we think a lot of people took the shares and then they were selling down. So to me, I think that's sort of that excess supply has taken a discount. And what you normally find is, as you grow listed investment companies, that you tend to get more of a premium rating. And I know we'll be talking to Matt in a second, and that's one of our logic behind growing WAM Leaders. When we floated WAM Leaders, it was 400 odd mil, now it's 1.7 billion. And you look at the smaller listed investment companies, the listed investment companies sub 200 million market capitalisation. I think the average discount's 15%. Where at the larger end, the AFICs, the Argos, WAM Capital, WAM Leaders, they're trading at premiums, or if not NTA. So we're pretty confident that we'll get back there. It'll just take a bit more time to tighten up the register. Why don't we move over to Matt? Because I mentioned WAM Leaders, and so Matt, in terms of how you guys invest, being focused on the top 200 is tough. And in terms of, congratulations in terms of your performance. I remember 3 and a bit years ago when you outperformed by 10%, I thought, wow. And then you've been able to do it successfully for those 3 years. Obviously, I think Kate said it in the morning, don't assume we'll keep doing any of this stuff. But it's been exceptional. And do you just want to give us a little bit of a feel of how you do it? Because you've got, we're talking to macro, you've got various macro overlays that, to really get that benefit.
Yeah, thanks, Jeff. WAM Leaders, let's just start, it's a top 200 fund, so we invest in the top 200 stocks on the ASX. As Jeff said, they're very much driven by the macro environment because they're growing like GDP plus, so they don't have the high growth as the small cap, mid cap stocks, which is why, in market downturns, small mids fall more, but then recoveries, they actually go up higher. What we try to do in WAM Leaders is we sweat every day trying to make your money work as hard as it can by using a lot of the macro data which comes out. So we'll stay up, 12:30, when daylight savings happens, sometimes it's 1:30 in the morning to watch data releases in the US to give us a lead on how to position the portfolio. So what we're trying to do is get data, then translate it into the ASX stocks, which are really related around those macro environments. And the reason why the Australian market is so macro focused is because of the stocks on our exchange, where we've got a huge chunk in materials, like 25% of the index is materials, and then financials around 40%. So these companies are really driven by the macro environment, which is interest rates, inflation, commodity pricing, FX. The Australian dollar is, the 4th highest traded currency pair in the world. because everyone uses the Australian dollar as a risk-on mechanism. When they want to get bullish, economic cycles, they buy the Australian dollar. So the backdrop is really macro-driven. So what we're trying to do is we do the bottom-up stock picking as well, but what we do on a daily basis is adjust the portfolio off the data we're receiving and watching every day. So we're really trying to drive performance every day off data. It's not trading for the sake of trading. It's actually adjusting the portfolio. So the bulk of the turnover is in the banks and resource companies. They're highly liquid and they are more macro-driven. And at the core of the portfolio is still around high quality stocks, management, high quality management and the like, with earnings growth. But there is that overlay of banks and resources which drive a lot of it.
And just on that, so you're saying you're active there. Just to give the guys an idea of how active you are, how many times a year does the whole portfolio turn over?
Yeah, I mean, we're turning the portfolio over around 5 to 7 times a year.
Yeah.
In the high frequency periods. We'd love, one of the asset consultants said, your turnover is a function of not having confidence. And we're like, actually, no, it's the opposite. The high turnover is because we've actually got data behind it. It's not turnover for the sake of turnover. It's actually, there's always a reason why we're changing the portfolio.
Yeah, okay. And you mentioned the banks. Obviously, I'm sure a lot of people here, a lot of our shareholders own the banks. What are you seeing there, and what's your view of the banks at the moment?
Yeah, let's go into the domestic banking system. When we fortunately, with the increased size, we get to see the CEOs and CFOs of the Australian banks, and it's really, the environment was set up really well for the Australian banks. You had interest rate increases, which are great for banks because what they do is they take our deposits, which they give us not much for, and then they can charge their mortgage rates around above the cash rate. So as interest rates go on the rise, their net interest margins increase. So rising interest rates is a great environment for banks. But what we're seeing since October is competition within the banking sector give away all those extra returns which we thought they were going to have. When we were speaking to the CFOs, they were thinking the net interest margin peak would be about 2 months post the last RBA hike. But what we found out is the competition has resulted in net interest margins rolling over in October of last year. So the environment for banks is not as good as we hoped it would be this year. That being said, you've had Silicon Valley Bank, which Katrina explained well. That was very isolated. But we're seeing some stress in money markets in the US, which Australian banks get a lot of their wholesale funding from the US because they're deep liquid markets. But in the US at the moment, the 4-week Treasury is yielding less than the overnight rate, which is basically saying you could have a 1-day term deposit giving more than a 30-day term deposit. And that's showing people are having non-economic reasons for owning a 4-week Treasury, which is really around collateral shortages. So there is signs of stress, which we're watching at the moment. So not all is well. There is stress. The range of possibilities where we're heading is we're in a slowdown. We probably can all agree on we're in a slowdown. It's that depth of the slowdown now and the reaction function of central banks. We've got interest rate cuts priced in the US, 50 basis points, but Australia's flat for the rest of the year. So a falling interest rate environment isn't great for Australian banks. So long story short, Australian banks, not that constructive on them at the moment.
Okay, and of the Australian banks, who do you like? What's the pecking order?
Yeah, so there's 2 parts to that question. What are the good banks, and then what are the trading ideas around the banks? So sometimes the trading ideas aren't the order in the good banks. So ANZ we think is reasonable at the moment.
Is that a trading idea?
Trading idea,
Yeah.
not.
Yeah.
Yeah, trading idea.
Yeah.
Then Westpac as well,
Okay.
because these are the deeply discounted banks.
Sounds like another trading idea.
Trading idea.
Yeah.
And then the quality banks, which
Yeah.
we like, are NAB and CBA. They're reasonably priced, but I think CBA's are over $100 again now. It's really expensive, but great management team. Matt Comlin, fantastic CEO,
Yeah.
but valuation makes it hard. So like we were saying before, we trade around a lot, and banks are where we trade around. So we'll adjust our total weighting in banks, but also the composition of the banks all the time.
But at the moment, from what you're saying, you're underweight.
Yeah, underweight the sector by like maybe 8%.
Yeah.
And then we've got ANZ and Westpac and NAB at the higher weights and CBA at the lower weight.
Yeah. Okay. And in terms of like another, sort of global theme that has a big impact on Australia is China and what's happening in China. What are your thoughts there?
Yeah, China's an interesting one. Like, obviously, the economy has been effectively closed for a couple of years, and the government are stimulating again. Their credit every month has been beating to the upside. So the total social financing, which is a broad measure of how much credit generation there is in the economy, has been beating every month. The reason why it's so important for us is traditionally through iron ore, really. I mean, iron ore, China are the biggest buyer in the world, Australia the biggest iron ore producers in the world. So when we talk about China, it's really an iron ore story, but also the importance of China as a global growth engine too. The rest of the world is shrinking, China is actually growing. So for us, China looks reasonably attractive. If we do go into a deep decline on the global stage, then it won't be immune. But for us, China's so important for us around BHP, Rio, Fortescue, and then some of the other smaller mining companies like Iluka, South32 to a lesser extent. But we're quite constructive on China for the time being, as long as that credit generation keeps going through, which it is going through. So for us, it looks like a reasonable place to invest for the time being.
No, look, thanks, Matt. And just on WAM Leaders, obviously, we're in the middle of the share purchase plan on WAM Leaders. We were going to do the share purchase plan earlier in the year. I've had a few questions about that. The reason why we put that on ice was when Silicon Bank, the volatility there was occurring, and what we had a situation where people had put their money in, which they thought they'd put it in at NTA $1.48, which was back then, and with that volatility, the portfolio had dropped to the low 40s. And as a board, we thought, hey, look, the best thing we can do is give the money back to shareholders and then wait for things to settle down. And then when we've priced it this time, well, you would have seen we did the placement to sophisticated investors a little bit above NTA. Shareholders in Leaders, they can get in at NTA, or we've got two pricing points. Now, this is to deal with any volatility towards the end, the 5 days before it closes on the 12th of May, as the other pricing point. So in theory, all the other shareholders that want to participate in the share purchase plan will have those two points, which we thought, the board thought was a very logical and equitable way. And I can't help myself, but to get a bit of feedback, which I know is not necessarily logical feedback. I look at hot copper from time to time, and just to help the people on hot copper, they're saying, "Oh, look, you're 10%. You've been diluted by 10%." When the money came in from the placement last week, within half an hour it was invested, so you're not diluted at all. And there's some. And from our perspective is, as I mentioned earlier, as we grow WAM Leaders, we saw it trading at a 6 or 7% premium. We'd assume once this washes through, this capital raising, then it'll go back to where it was. And one of the things we do find is the larger listed investment companies, the financial planners, the people that are looking for liquidity, looking to be able to buy $10 or $20 million worth of stock in a short period of time, are prepared to pay a premium. And that's why I think the larger LICs do get that premium rating. Why don't we, Oscar, let's go over to yourself. Do you just want to talk about how the money for the mids and smalls, which is effectively WAM Cap, WAM Research, WAM Active, WAM Microcap, is managed?
Yeah, sure. I mean, thanks, Jeff, and thanks, everyone. But yeah, the way we've managed all those four funds has been very consistent over the last 25 years and has stayed the same way in good markets and also in bad markets. So we focus on small cap industrial companies that have a catalyst that can see a re-rating of the share price over time. So we like small cap industrial companies, as Katrina and Matt have both said before, is you have a very strong longer term growth outlook, independent of market cycles.
And pretty much the last 12 months has been pretty tough. I know the performance numbers recently have been very good, and congratulations. But even in that tough period, you've outperformed the small ords. Do you just want to give us a little bit of talk us a little bit about the last 12 months, or
sure.
where we are now? Particularly that chart you sent me this morning. Yeah.
Yeah, so as Katrina pointed out, it's been a very, very tough period for the market, which really culminated in the March quarter of 2022 when we had inflation starting to come through, the aftermath of COVID, and then more importantly, the Russia-Ukraine war. So that hit the market very hard, and it hit smaller companies even harder through that period, which is what you would expect with a period of uncertainty. So look, while we were disappointed with our performance over the last 18 months, I think it's worthwhile noting that over the last 25 years, we've had many periods such as this. They're short-term in nature, and I guess, as you say, Jeff, you've got to look through the longer term, have faith in the investment process, and as it stands today, we're seeing a lot of opportunities at the moment, very excited for the future. And
just on that, there's a bit of corporate activity in your space. Do you just want to give us a bit of a feel there?
Yeah, there has been, just generally with the market over the last 6 to 12 months, but we have been lucky. So we've had 3 takeovers within WAM Capital in the last 3 weeks, and 2 of those are quite sizable positions in the portfolio. They've got to complete though.
Yeah.
But it is good to see, and it shows, it's what we've been talking about for some time, that there's a lot of companies out there in this space trading at what we consider is below fair value. And I think what's more importantly as well is a lot of our companies, or most of our companies, have very strong balance sheets. So we actually see a very positive period for capital management or accretive acquisitions at this point in the cycle.
And looking in the next 12 months, what are you?
Yeah, very, very positive. I mean, as Katrina said, valuations are at, on a relative sense, at 20-year lows. As you said, we've seen more corporate activities, balance sheets are strong. There has been a huge divergence between sectors. There's been some really good sectors over the past 12 months, and it's in the bad sectors, which unfortunately that's where a lot of WAM Capital invests in auto, retail, building materials, property developers, etc. That really can, we think is trading really cheaply right now, and should have a good period.
Great. No, thanks, Oscar. Dania, let's go to alternate assets. Now you've been managing that portfolio for 2.5 years, and I know when you were quoting the other day, you were quoting sort of the last year's performance, the discounts, but pretty much when you took over was, trading at about a 30% discount to NTA. Obviously, you've done a bit of repair on the shareholder base, but also on the portfolio. Do you just want to give us a little bit of a rundown of WAM Alternate Assets? Sure. and what you're doing there?
Thank you, Jeff. So first of all, WAM Alternative Assets, if some of you don't know what's in this portfolio, I invest in alternative assets, and those are the assets that are outside traditional asset classes. So anything outside equities and bonds, we can consider alternative assets. I invest in private equity, real estate, infrastructure, real assets, private debt. To illustrate with an example, in Sydney, in New South Wales, we have an investment in Gosford Private Hospital. So that's a very good example of an alternative asset. It's a large asset valued over 280 million. It has very long lease profile, so it's leased to an operator for over 20 years. Its value doesn't change day to day, like what you see in other asset classes. And it has pretty stable, predictable income return and some potential capital appreciation over time. So when you think about alternatives in Australia and globally, it's those have been the asset classes that were very popular and are still very popular among wholesale investors. if we look at a future fund portfolio, our sovereign wealth fund, you'd find that they've been investing in those asset classes for over 20 years. It's about 30% of their total portfolio, and for very good reasons, right? So when other asset classes go down or experience a lot of volatility, you'd see that alternative asset classes bring very strong complementary benefits to any investment portfolio. They continue delivering pretty stable, predictable returns. They potentially can provide protection against rising inflation, against rising interest rates. They can give you access to many interesting themes that are not necessarily available in other asset classes, more traditional asset classes.
And looking over the next 12 months, what areas are you focusing on, or?
The next 12 months, the focus from the investment perspective will be a lot on opportunities within private equity, healthcare. In particular, there are some great deals in the market currently at attractive valuations, and then renewable energy, and potentially looking for opportunities where we can find more protection against rising interest rates like private debt. But I'd also add that, when I look at the portfolio and the current share price, in my mind, it should be trading at premium to NTA, because as you said, we've made a lot of progress on the portfolio itself. So the quality has improved. The NTA has grown from $1.05 to $1.26. Profit reserve went from nearly 0 to 20 cents a share. And the share price has improved significantly. So I'd also add here premium to the fact that we bring this high quality portfolio to our shareholders in a liquid structure, which is otherwise only available to large institutional investors. So to some extent, it's your classic case when you say, buying $1 at 80 cents, in this case at 87 cents, but there will be a lot of focus on continuing engaging with you, answering your questions, and demonstrating with the portfolio that we can deliver on investment returns.
And just be patient, Danya. It will trade at a premium. It just takes time. The longest of all ours was, I think, WAM Research, which traded a little bit of a premium at the start. Then it took us 7 years to get it back to NTA. I'm sure it won't take that long for WMA, but it just takes, because when you've taken it over, there was a different shareholder group, and then the ones that want to go for the journey stay, the others leave, and then it takes time to just to tighten up the share register and get things trading at NTA. Well, actually, just on that, because in theory I'll ask myself a question, because there's a pool of capital that I'm in charge of managing, which is WAM Strategic Value, and anyone who participated in the IPO would be disappointed, as I am, in terms of where it's trading. The actual NTA is $1.15 of WAM Strategic, and it's trading around that, I think around the mid-90s. And again, I think it's been a volatile period, so a number of our shareholders have departed. That's the supply side, and it just takes time to tighten that register. In that space, where WAM Strategic's sitting on 30-odd% cash, and the interesting thing is, on those buying $1 of assets for 80 cents, go back 2 or 3 years ago, it was mainly focused on mainly listed investment companies, and it was more the global listed investment companies were trading at big discounts. We bought some of the Magellan listed investment trust at a 20% plus discount, and there's various others there. But more recently, we've seen some operating companies, because of the volatility of the market, have turned up trading at discounts. And we had a couple of percent of the portfolio in AMP, which we bought in the low, just above it. I think it was $1.06 we started buying, sold a third of it at $1.30, and then replaced that when it fell back to around that little above $1 level. And the NTA for AMP is $1.70 plus. So we're still of the belief that they will get their act together. If they don't, I'm sure shareholders will. I think the shareholder base they've got at the moment will hold them to account. And another one that we've been buying recently in that space is global data centres. They've pretty much said, hey, it doesn't work as a listed vehicle. The discount was far too much. So there has been some interesting ones in that. So that's pretty much thank you for your questions that you've sent in, and we've tried to sort of consolidate them with that. Now, why don't we open it up generally for questions? And what I'll do is we'll try to be democratic, and we'll go across from right to left, and then we'll do two in the left and on the way back. Actually, I should adjust for the number of people sitting in the sections. But why don't we start over? Any general questions or specific questions? Please, if you put your hand up, we'll just raise the lights. Yep, great. There's one. Thanks. Oh, we'll start right over there. Yep, that's great. And then you'll be number two. Thank you.
Thank you. My name's Alan Wilson. I was interested to know, it seems to me there's a lack of exposure in the agriculture sector in your funds. You have been into Ingham's, I think you're into Ridley and a few others, but what's your general outlook on agriculture and how you're going to adjust your weighting in the future?
Okay, no, good question. Just about agriculture. Yeah. What exposure do we have in the funds, and what's our outlook?
So agriculture, I mean, as I'm sure you're all aware, has had an amazing last 2 or 3 years. Basically, as soon as COVID occurred, it rained very consistently on the east coast of Australia in particular. And a couple of years ago, Elders, GrainCorp, were big parts of the portfolio. Now, we sold those businesses probably about a year ago because we just thought conditions couldn't get any better. But in terms of how our portfolio looks now, our biggest holding is Select Harvests. We own, it's about 1.5% of the portfolio. We own about 6% of the company. It's probably the only...
That's our biggest agricultural
holding.
Yes.
It's probably our only holding at the moment. Why we like that is because it's probably the only soft commodity globally that hasn't gone up over this period. It's actually, the almond price is at record lows. It's trading at a discount to its net tangible assets. So we're happy to wait there and wait for an average almond price, and earnings will come through.
Yeah. Any other agriculture? No.
Yeah, we have agriculture in WMA, so quite concentrated exposure to one specific asset, American citrus. That's, as you know, Australian citrus has been in high demand, so probably still a few years until it matures, but I'm looking at this as a high potential investment within the portfolio. Definitely agree.
And what percentage of the portfolio would that be?
So agriculture is about 10% of the portfolio, quite an important asset class for us.
Okay, thank you.
So, Jeff, you mentioned about global data centres. What has happened there? You've said
just on global data centres. Broadly, the CEO has come out, there's been an announcement by the board that's basically said, they basically said that a listed structure isn't the perfect structure for them. So they've restructured all the management agreements and performance fees, etc. So, and they basically said they'll sell off the assets. And for the management company to receive the same amount of money it would have over a 3-year period, and it's all sort of focused on occurring over the next 3 years. The share price around the mid-$40s, $50 level. The NTA is $1.93, but for the management company to get the same amount of money, they've got to get $2.25. So you'd assume over the next 3 years that'll turn to cash, and then be returned to shareholders. So it's obviously you don't get the benefit. If the equity market rises significantly, you won't get the benefit, but it's a good sort of medium-term return on capital. That's what we like. Thanks. We'll go here next, and then we've got the lady. Thank you for the question. Just, well, you know, it's interesting I don't know, in terms of being politically correct, do I say men and women or do I say ladies and men? I'm not sure which one. Anyway, but no, I was asked the question, when we're out there having coffee about who are the better fund managers. Are women or better investors? It was more general. It wasn't. Are women or men better investors? And all the research I've seen are that women are better investors than men. And so there should be more women here. And thank you for your question.
My question, excuse me, my question is for Oscar about the WAM Capital portfolio. Excuse me. Given the increase in interest rates, particularly the rapid increase we've seen in the last 12 months, how do you see the management of the portfolio going forward as long as interest rates keep increasing or don't decrease? Because it's going to be harder for small companies to raise capital, it's going to be more expensive, and they need to grow. So how are you generating capital to pay the dividends that WAM Capital has projected that they will pay in the next few years? Do you actually trade more? Do you short stocks? Or do you concentrate more on the mid-size caps?
Okay, so
and there's probably two parts to the question. You do the first part, I'll do the second part.
First part of the question. So what we saw, and Katrina also touched on this, around this time last year, we saw a big divergence in sectors in the market. We had a lot of resources companies do very well with the Russia-Ukraine war. And we also had inflation, which meant that a lot of the companies exposed to the economy, so automotive, retail, et cetera, they've done very poorly over this period as the market has anticipated rising inflation and rising interest rates denting consumer confidence. So that part of the market is around 50% of the stocks that we invest in. We can't avoid it. So that part of the market has really dragged the small caps down. Now, what also happened through that period though, which is on the positive side, is that a lot of the analysts, so the stockbrokers following these companies, have really hit their earnings forecast very hard, anticipating a very, particularly a year ago, I think we all thought we were going into recession this year in Australia. I think at this point in time, it's probably not as bad as what people thought. So that's actually a really good time for us to invest. This exact same thing happened around COVID, where people thought it was a very negative scenario playing out, cut their numbers very hard, and then 3 months later, we saw actual numbers going up. So that's where we think we are right now, and that's why we think small caps will have a very good period, notwithstanding that the economic environment is tough looking forward, because a lot has been factored in on the negative side. Now, in terms of the second part of the question, we won't be changing the way we manage the portfolio. It's exactly the same way. So in terms of the profit, or when effectively the capital that we generate to pay your dividends, around 70% of that is through unrealised gains in the portfolio, and 30% is the dividends that we receive from our companies and then we pass through to you. So the fact that we go in a rising interest rate environment, it doesn't really impact, I guess, at the view of whether we can pay dividends or continue to pay dividends. What really matters to us is the market keeps going up and we perform in line with the market and can keep building upon that profit reserve.
Or the market goes down and you go up.
Correct.
And the portfolio goes up. Yeah. To me, it's really the
balance sheet. Sorry, I was going to say you had a great stat on the balance sheets of the
I got to one. Yeah. So to put it in context as well. So a bit of research we saw a couple of weeks ago was if we go back to 2007, and someone did this on the small cap sector as a whole, the ratio of what they call net debt or borrowings to earnings was about 1.5 times. Today, it's 0.5 times. So that we don't see the same amount of leverage today as what we saw back in 2007, which is what I was saying before, that we actually see a very, very good time for our businesses that we're in the portfolio to actually be acquiring other businesses. It's a good time to be doing it. Rising interest rates brings valuations down. And if you take a view that, like we have, that we think that interest rate rises are now moderating, could be a very positive period for the market.
And just go back to the other part, is then how is the dividend paid? And in terms of that, and that's why on a monthly basis when we announce the NTA, we announce the profit reserve, because to pay a dividend, you need a profit reserve for it to be franked. You need the franking. And in terms of the profit reserve, with WAM Capital, we've got pretty much the next dividend and the dividend after in the profit reserve, and more money, in theory, to continue paying those dividends. Then, as Oscar mentioned, the portfolio needs to go up. Money, capital needs to be made. And just on that, in terms of, just to get someone asked me the other day, they said, well, like the share price was trading up here, now it's trading down there. And if we go all the way back, I think years ago, someone asked me, they said, we're sort of disappointed with your performance versus the market. And I went and had a look at that and did the numbers. And what you find is when a company's paying an enormous fully franked dividend, and say, look, with WAM Capital is paying, say 15.5 cents on assets at the moment, they're $1.45, so it's nearly 11%. You're getting fully franked. So to actually earn that, say at the pre-tax level and pay tax, it's a little over 15% that you've got to earn. So and the the market, the current All Ords is probably yielding 3.8% or something like that, and it's probably 77%. So in terms of your return, if we were paying this a 4% yield, then you get more capital gain. You sort of can't have both. You can't have a 10% fully franked dividend and expect 10% capital gain. We can give you no fully franked dividend and we can give you 15% or 10% capital gain. So to me, it's one or the other. And with WAM Capital over the last period, it's been tough, as I think Oscar or Katrina mentioned, that it's been one of the worst 1 year period over the last 60, 70, 80, or no, 100 years, isn't it?
Yeah, well, I'll put in
Yeah.
I remember that February 2022 reporting season like it was yesterday, because we had a really good reporting season. I think it was like we had 70% of our companies beat estimates, which is unheard of. And I think it was our worst month ever in WAM Capital, because everything hit all at once.
Yeah, and that was just a PE contraction, wasn't it?
Yeah.
No, thank you. Good question. Yeah.
You've got a DRP going in all your listed funds. I noticed the one for WAM Strategic, you're buying those shares on market rather than issuing new shares at a big discount. Why do you not do that for WAM Global, where that discount's almost 20% and you're issuing new shares? You're always telling us we like to buy things for 80 cents in the dollar, and here you are selling things for 80 cents in the dollar.
Yeah, very good question, Simon. And the reason why we're doing it WAM Strategic is we're just testing it out. That was the logic. The WAM Strategic board obviously came to that conclusion, and it made sense in terms of. I mean, I agree with your logic. The interesting thing is the participation in the DRPs are very small, and from our perspective is we're pretty confident it'll only be transitory, these discounts, and that at some point in time Global will trade at a premium. And what we do is the broad policy is when they're trading at discounts to NTA, then we'll do no discount in the DRP. So we're not trying to encourage people to go into the DRP. A lot of people use the DRP, particularly for their children or grandchildren. It's just an easy way of, rather than just accumulating a position in a company. But good question, thank you. And far left, Emiko, thanks.
Just wondering whether you look at the small biotechs, there's been some pretty good performances there in the last year, particularly Neuren Pharmaceuticals and Telix. Do you look at that space?
Historically, it hasn't been a space we've looked at. However, there's always an exception to the rule, isn't it? Will Thompson, who's in our team, did a great bit of work around May and June of last year when the market was at its worst, and looking at sectors that bounced the hardest coming out of a downturn, and it is actually biotech. And we bought some small positions in Telix, and we also did with Neuren Pharmaceuticals. And Neuren, I think, is probably be our top 5 best performing stocks this year. And we took a bit of a risk on a binary outcome, and it actually came off. And actually, the business now, it's actually, despite the run, it's actually trading very cheaply on about 11 times EBITDA or earnings, let's call it. So it's transformed in the space of 6 months into a real business, which can often happen with biotech. So we don't own Telix anymore, but Neuren still is a key part of the portfolio.
And we, from the global perspective, we tend to like to invest in the picks and shovels rather than the more speculative end in terms of binary risk around trials. So we have a number of holdings such as Thermo Fisher Scientific, ICON, which is a clinical research organisation that kind of benefit from when biotechs, are doing clinical trials, etc. But rather than investing in the actual companies with the binary risks.
Yeah, and I think it's worth noting, we bought those too, and it was 1% of the portfolio, I think, in total around that period. So saying that though, Neuren's been a really good company for us.
So Bridget, yeah, thanks.
Yes, good morning. A question about WAM Capital. I believe in the principles of don't lose money, number one. Second one is the value of compound interest. So about 5 years ago, I bought quite a lot of WAM Capital shares at $2.50. They're now trading at 1.73. I elected the dividend reinvestment plan because these are for my grandchildren. I've set up some systems for my grandchildren. That's 30% discount even with the dividends reinvested. So I'm pretty disappointed. I know you don't give advice, but what do you think about that?
Oh, well, yeah, I don't need to give advice on that. No, I mean, broadly, the WAM Capital was trading at a 25% premium to NTA. And I mean, what we talk about is trying to buy things at a discount to NTA. And WAM Capital now is still at a premium. It's about a 15% premium, but the premium's declined. And that's one of the problems with premiums is, like if it declines further, then when you pay a premium, that's difficult. And it has been a tough period, for small caps. And I'm not exactly sure what the accumulated dividend, in terms of, obviously because we've been paying out, double or double plus of what the market's yielding, what that gives you. But back then, I think it was trading at a 25% premium. So it's a tough time to buy. You're taking a lot more risk. That's right. I mean, the of our funds, like WAM Research is trading at the highest premium. That's 30% plus. Obviously that's they're big premiums, and the biggest discounts. Global's at the biggest discount. Then I think strategic and alternate assets are trading at reasonable discounts, and then leaders trading around actually a slight discount now. Well, depending on if you adjust for the current market performance, and then active a slight premium, and WAM. Yeah, I didn't mention WAM Capital. That's the tough part. Someone in here? Yep. Thanks. That's great.
Good morning, and as always, thank you for your time today to put on this presentation. A question to each of the fund managers. You've talked in touching on the subject of risk and risk management. So as active fund managers, a simple question, what risks are you actively managing, and how do you manage them?
So who wants to start?
I can start and kick off. So yeah, I mean, every day we're looking for risk. What we're managing for risk now is obviously the economic slowdown. So within WAM Leaders, we've been very defensively positioned for maybe 6 to 9 months. So within the fund we run, we don't take excess risk through companies. So we're always trying to outperform using quality companies. So the way we manage risk, the economic slowdown, is positioning within sectors. So we've been heavy in infrastructure, consumer staples, health, and anything really leveraged to falling interest rates, because we think interest rates are going to be cut potentially this year because of the economic slowdown. So the greatest risk I see now is for the market to get too excited around those cuts, which we're seeing now. Like, a lot of the small caps are running and speculative end is running ahead of the economic slowdown, which has never happened in history. So the greatest risk we have is being left behind, not chasing returns now before the slowdown. So it's gone from a defensive positioning now. We've got to work out, like, the bond market is saying we're going into a really tough time. Equity markets are running. They're going, hey, all good here. There's a big dislocation. So the greatest risk now, like we're trying to manage, is how do you position for the upcoming slowdown, but then also the easier policy which will come with that, which is traditionally good for equities. So the greatest risk now is more, how do you manage over the next period not being too defensive, still having enough cyclical elements to the portfolio? But I mean, we manage that daily. And we've got a lot of levers within the large caps because they're all liquid companies. We've got cyclical, we've got defensive, but it's more of a sector because we don't try and pull the cash lever unless we see a GFC event, which we don't think is going to happen because of the leverage is not in the system at present. So for us, it's around sector rotation and going up the quality curve too, which we always have high quality, but we even go higher quality. So within the sector, like we'll look at Woolworths, Coles, we'll go, hey, Woolworths is trading better run company, higher weighting in Woolworths. Within infrastructure, we go, which infrastructure has the best exposure, the debt profile, look at all the quality characteristics. So that's really how we manage risk within Leaders.
And for us, I guess, in terms of the companies and how we're positioned, it is really around resilient growth. And each company that we own, we think, we track how we think the earnings are going to grow over time. We use our investment process, that's been in place for 25 years, which is really, we are focused on those businesses that are, have strong industry positions, high quality management teams. We focus on balance sheet, not, buying companies that are highly leveraged. We buy businesses with valuation support so that, we weren't in the unprofitable tech companies. We don't own any, we actually don't own any banks, and don't own any US banks. So we think we've taken some of the risk out, and we think that the companies we own, where we have very strong earnings growth and where we have valuation support, provides a level of risk management as we look forward.
And just quickly for us in small cap land, we've got a team of 6 within WAM Capital Research, Active and Micro, and we're probably seeing on average 4 or 5 companies a day across the team. And in small caps, it's very risky part of the market, and things can change very, very quickly, and even more so in the last few years. So for us, it's being on the ground, speaking to companies, speaking to competitors, speaking to suppliers, trying to get the best information. And the way we've always managed WAM Capital as well is, it's quite a wide dispersion of companies in the portfolio. The highest weighting would be around 3%. So it's not like we're putting all our eggs in one basket and putting 10% of the portfolio in one company.
And Danya?
I'd briefly, my investment process is quite different, and so is the portfolio construction. I don't have 6 or 7 times turnover per year within the portfolio, and a lot of the risk assessment at the investment level really happens at the very start when I do investment due diligence, because then it's illiquid investment for 5-7 years, and it goes across various areas like operational, governance, other external risks. And in terms of the monitoring of the risks, we do have risk assessment framework that we then report to the board. We monitor the portfolio on the monthly basis in terms of the valuations, performance, and any of the operational changes. But happy to answer this question in more details outside.
Thank you. Thanks.
Just a general thing about geopolitical risk, and in two parts. One, sort of seems a bit of wind back on globalisation in terms of going back to domestic production. The obvious problems that have come up in terms of threats to supply chains, etc. And also that's the longer term slower changes, and the other one is the obvious acute type of risks, like, for example, Taiwan.
Who wants to do the geopolitical?
Yeah, sure. I can start on that. In terms of like Oscar and Matt, we're constantly talking to companies that we own, competitors, suppliers, etc. And so I would say that deglobalization trend is huge at the moment when we talk to companies. Any manufacturer is, when they're setting up new facilities, they're thinking about taking production where they can, when they put incremental capacity in, they're thinking, where can we put it other than China? Because everyone realised through the trade wars and the pandemic how high the reliance on China was for global supply chains. So Nick and I were just in Japan in March, and when you talk to there's a lot of manufacturing businesses in Japan. I mean, even in Shiseido, which is in the makeup area, for example, they're adding new capacity and they're saying, we are not going to add in China, even though we realise it's an enormous market. We will look across other parts of Southeast Asia, and where we will look domestically in Japan to add capacity. And we see that in the US. You've seen Mexico, for example, be a massive beneficiary of, when companies are looking to supply into the US, they're putting into Mexico. When companies are looking to supply into Europe, they're putting into Eastern Europe, because everyone's realised, if we can, they realise, there's a lot of integration, and it's very hard to unwind a lot of that supply chain that is in China. But when they're adding incremental capacity, they're thinking about, okay, how can we get it as close to the end market that we're trying to serve as we can? And we see that in any geography, in any company we talk to, in whichever geography around the world. So that it is a massive trend that we are seeing now. It is very slow moving though, because unwinding what you have, and whether it's the auto industry in Australia, for example, how do you get that back once you've lost it? So these things take time, but certainly, we own lots of global businesses that have manufacturing in every geography, and we do see that as a big trend, that they are trying to work out how to be more broad-based in where they get their supply chain from.
And just on that, there's a great article in the Fin Review just recently. Jonathan Shapiro wrote it, and he was basically saying how that cost is probably going to add, was it 1% to inflation globally per annum, or consistently?
Yeah, it is inflationary, because it is more cost. China's been it's been a low-cost alternative for supply, and it is inflationary. And on the Taiwan question, again, it is at the back of even companies' minds, and we ask companies, we say, like, what would be what would you do in that scenario? And it is difficult, and that's a part of the reason they are trying to move manufacturing, etc., and supply chains to be closer to home, because we don't know. There is potential for an escalation, and it would be extremely disruptive to lots of industries. I mean, we've seen the disruption around semiconductors, and if you look at semiconductor supply and how much is out of Taiwan, it's enormous. So it would be a big issue.
Oh, we're meant to go that way, to that side. Yep. And then we'll come back.
Oh. Sorry, we'll take it later if you want to, but just a question on materials. You said 25% of the top 200 are in materials, I think you said, Matt. I was just wondering how you're positioned on materials, and in particular, iron ore, gold, copper, and oil. Thank you.
Yeah, sure. On iron ore, we traded them down probably, it'll be about a week and a half ago, because again, like this is part of the process. We got information that a lot of the blast furnaces were going to maintenance for a period, and this is where like it actually doesn't change the value of the companies, but in the eyes of the stock market, when they see the spot iron ore price decline, people sell them. So we thought that would be the case, and thankfully we have reduced them a little bit. But like longer term, we're actually quite constructive. So again, it just goes back to the process. Like new information, you adjust the portfolio. But long term, quite constructive because, I mean, property is the base of wealth in China. There was political unrest. They went through a 5-year program to try and get the speculation out of property. We're about 2.5 years through that now. So generally around the 2-year mark, they start to relax policy, and that's exactly what they've done now. So iron ore, still quite constructive on that. I mean, the big, caveat is global growth, but China's like 75-80% of domestic seaborne iron ore for us. So it's really a China story. On the other names, like oil, for our benefit, we're always oil bulls, and it's really again back to geopolitics. Like that's a constant geopolitical battle we're always facing with oil because it's most, as you know, OPEC plus, the group which controls output decisions, have actually been pulling back output. So we're actually, despite the economic slowdown, the actual supply side doesn't look too bad. So oil we like, and we like Santos in that space because Santos is about 5% of the portfolio. It's ridiculously cheap. They've had a few hiccups along the way though, so the market has sort of discounted that. But we think they'll work those issues out over the next 3 to 6 months. So we see a re-rating in Santos. Irrespective of the oil price, we think it could perform. On the other companies like Iluka, we like, again, back to geopolitical risk, the world is rearming off the back of Ukraine. So Iluka is involved in, obviously, mineral sands for like paints and the like titanium dioxide, but they have a rare earths project now, which is going to get a lot of international interest. So the government has given them, I think it's over $1 billion non-recourse loan, which is unheard of in Australia. So they've got all the stockpile there, they've got funding now. It's going to take a few years for them to build this, but the world is rearming. So from an investment point of view, we're trying to the only way we can capitalise in Australia is, predominantly through Iluka. We like South32, good mix, copper, manganese, some coal, they've been reducing coal exposure, which we like. But again, copper's a bellwether for industrial production. Industrial production has been slowing. Global PMIs actually ticked up over the last few months, but the recent survey data looks really, really bad. So maybe the ISMs, the PMIs roll over again. So copper, not so constructive on the outlook for copper. They're probably the main ones. And like copper, unfortunately, we can't get it through Oz Minerals anymore. That was our go-to. Now BHP have got Oz Minerals, in the process of getting Oz Minerals. So if we do like copper, we play it indirectly through Newcrest, which is obviously a gold company under takeover as well, but they have like 20% of their earnings through copper. But obviously BHP, the way you play it now is through BHP. On gold has obviously had a run up, volatility, gold goes up, forward interest rates. It's sort of like a default, when you think the world is going to debase the currency, the fiat currency, a lot of money goes into gold. So I'd say it was under-owned gold. Now it's sort of the ownership of gold is fairly neutral. But I would have thought gold looks pretty good over the next 12 months if we do go into this slowdown. If the other scenario is the economy is not as bad as people think, then gold will get sold off heavily because it's really a safe haven asset, a place to park money without getting a devaluation from expanding the monetary base. So they are the real signals for gold you've got to watch out for. But the way we play it is, again, we're losing all these great companies, so Newcrest is probably going to go, unfortunately. So Northern Star for us is the next best. And then you go down really, really low, unfortunately, like Evolution's having all sorts of issues and, capital starved. And then we just don't go down the quality curve post that because we like having liquid positions we can move.
Thank you. Yeah. No, we've got to go to the next lot. down. We've got to be fair to each group.
Hi, thanks guys, it's been so informative. This question's provoked by the question before last about globalisation. There's a lot of talk in the streets about re-industrialising the home countries, especially Australia. I think it's a big ask for Australia, but the people you've been talking to have obviously would be very high on the agenda of thinking about this stuff if it's feasible. Do any of you people see any significant likelihood that Australia will start to re-industrialise to any extent and recapture any of its, claw back any of its industrial capacity?
I'll kick off with 100% no. Just because, I mean, like corporations are there to maximise profits. I mean, if you did it, it would be counterproductive for companies and also for the GDP of Australia if we actually did that. So I can't see an economical reason. For security reasons, you know, data, there is a movement for that, but it's low cost. It's not. There'll be, I don't want to be presumptuous, but I don't think there'll be massive capex on the industrial side in Australia for the foreseeable future. So on manufacturing, I'd highly doubt it. I mean, like companies like us, like CSL, have built a big, you know, new building down in Melbourne, but I just can't see it happening at our end. I'm not sure if, Oscar, you could see it with your own companies.
Nah, I would say, look, I'm thinking oil and gas on new projects for oil and gas on the East Coast. Like, it's just, the government's just doing everything they can to make it difficult. So until that frees up, I can't see it.
No, exactly. Like, you know, more taxes, you know, PRRT, potential changes there, no climate policy, gas policies in shambles. Yeah, it's hard to see any major capex or reindustrialisation of the Australian economy at the moment.
And just before we take the next question, you know, the budget's coming up. What's going to happen?
Well, yeah, we thought the banks would get hit, but they've sort of ruled that out now, which is interesting. We were talking to all the banks, and they're like, they were scared of the budget. They thought they were going to get hit, but they sort of ruled that out now. So. I mean, they're looking to, obviously the migration's come back strongly, so, you know, build to rent is sort of maybe a policy tool they want to get going, which is sort of like tax breaks to build some apartments and the like. But it's going to be pretty vanilla from what we're seeing. Oscar's probably got some anecdotes on the, you know, childcare, I think.
Yeah, childcare is going to be very positive. Well, that's already set in stone anyway. Aged care as well. But yeah, that's pretty much it. It feels fairly vanilla.
Yeah, thanks. And yeah, thanks, Zoe. Yep. Yes.
Thank you. I'm seeking your thoughts and input on two areas. One is the climate change, green energy area, where global business was already more in favor than Australian business, but in the recent past, Australian business across the board seems to be more on board. So in that area. And second is the artificial intelligence, which is also growing. Now, in both of these areas, as you know, there are some very established players for a long time, and there are a lot of newcomers which can fall into the speculative area. So what are your thoughts in terms of investment in these two areas?
Yeah, so broadly investment in climate change and benefiting from climate change, and the second one was in AI.
I can do a broad climate change. I mean, fortunately, in the large cap space, they take care a lot of that for us. They're all moving in a direction. So for us, we just got to make sure they're moving in a direction. Like, how do we take advantage of it? Like, domestically, everyone's crying out for some policy certainty. Like, we speak to AGL and Origin, they're like, we don't know what the government, we don't have a framework, we can't invest money. So everyone's screaming out for some policy certainty. I mean, that's in a very specific area, but I think globally Australia's been left behind. And I think it's really been, we haven't had bipartisan policy support. So it's still up in the air. So the companies we speak to just say, hey, give us some guidelines and then we'll adhere to them. But we just don't have any guidelines that's on the climate for us.
Look, on the small cap side of things as well, you know, very small companies obviously, but you do see some great opportunities for companies that you see them and you go, oh, this has got an ESG or social governance angle to it, and you know that it will get a premium valuation. So we've got a couple of companies. So Mermaid Marine's a great example, been around for a long time, was 100% in the oil and gas industry, and all of a sudden it's starting to do offshore wind projects, and it's 30% of the revenue. So you look at a company like that and you go, oh, once the market works that out, it'll have a premium valuation associated with it. And then on the AI, I mean, do you want to talk about AI?
Yep. So firstly, I guess from the climate change perspective, we own a business called Quanta Services in the US, which is the largest contractor in terms of upgrading the grid across the US. So that the electrical transmission grid in the US needs it needs to be upgraded hugely, and they're the largest player to do that in the US. So and in the US, we've had the IRA, the Inflation Reduction Act, which is going to provide massive funding towards basically bringing those renewables onto the grid, etc., which will be a massive tailwind for Quanta. And then on AI, it's really interesting. I was just in San Francisco in March for a massive Morgan Stanley Tech, Media and Telecom conference. There were hundreds of companies. Every panelist, every company that presented got asked on AI, what's the impact? How do you see it impacting your business? And we have a number of holdings in the fund that will, as it evolves. I mean, it's early days. The actual Sam Altman, who's the founder of OpenAI, which owns ChatGPT, presented. It is early days. The models still need work. The outcomes that are popping out of when you ask ChatGPT, for example, aren't necessarily always correct. So there is, it does need to evolve a lot further. But we have a number of holdings in the portfolio that are using AI in its infancy, and we think will be beneficiaries of the benefits that it brings in terms of efficiency and so forth. So companies like SAP, companies like Intuit, Adobe are all in the early days of utilising AI, and so it does have exciting potential, but there is some work to be done in terms of the security, in terms of the inputs.
And I think it's fair to say, sorry, Dani.
Yeah, I was going to say you've done yet. Yeah, sorry.
Oh, I was only on the climate change, that there are a lot of opportunities within alternatives like renewable energy infrastructure, within private equity space as well. So the challenge within listed equities is that Oscar is right, and Matt, that at the moment there are no established standards. How do you measure it across all the industries? So within private capital space, you'd probably see more activities on that front, driven by both investors, but also by investee companies.
I was just about to say, we're starting to see in the microcap space quite a lot, these AI companies, so I can envisage it becoming the next buy now, pay later. So anyway, watch this space.
Look, I've just looked at the time, and I think we're just on the end of the questions. But please, I think everyone from WAM's down here. Well, probably someone will be answering the phone back at the office. So there's 54 people here with a name tag. So if you have any questions, please ask any of them. And I'd like to thank the panel for their openness and frankness. Thank you very much. And the panel will leave, and then now I'd like to. Oh, actually, just to remind you, if you can do the survey, because this is your company, and any suggestions. And we had a great suggestion when we were in Canberra doing the presentation on Monday. One of the shareholders filled out there and they said, look, can you give us a summary of the questions and answers, the actual answers for the questions, but actually email it out to us. So we're thinking about putting that together. Just more the main questions that we went through rather than the other one. I know this is recorded, so you'll be able to hear it. But for a lot of people, I like reading things as well. So please fill those out. And what I'd like to do is now invite the Future Generation CEO, Carolyn Gurney, to the stage, who'll take you through the next part of the presentation. Thank you, Carolyn.
They say change happens 1% at a time. So what can you do to be 1% better today? You could take the stairs instead of the elevator. You could give a compliment instead of a complaint. Or you could change someone's life. 1% may not sound like much, but for young people in need, 1% can make all the difference. At Future Generation, we invest in a different kind of potential. We're the first listed investment company in Australia that delivers both investment and social returns. Future Generation provides shareholders with exposure to leading Australian and global fund managers. Their job? Delivering a stream of fully franked dividends and capital growth to investors. Our boutique fund managers also have big hearts. By not charging management or performance fees, we can donate 1% of company assets every year towards changing lives instead. As a shareholder, you can decide which of our preferred charities will receive your donation, whether it's helping children at risk or supporting youth mental health. Our carefully selected charities ensure your contribution is used in the best possible way. For shareholders with over 1 million shares, you can direct your donation to any charity of your choice. And as our assets grow bigger and bigger each year, so does the 1% donation. This gives our charities the financial security to think and plan long term. By 2030, we aim to have donated $100 million. And the good news is, we're already on the way there, having raised $65.2 million to date. With your support, 1% can make big things happen. To learn more about how you can improve the lives of our future generations, visit futuregeninvest.com.au.
Thank you. My name is Caroline Gurney. I am the CEO, thank you, this is my pinger, of Future Generation Australia. And I am delighted to be here today. And after this, we actually have a panel with Mike Baird, Jeff Wilson, and also with Jacob, who you'll also be hearing from now. And that's going to be emceed and hosted by James Thompson, who's the Chanticleer journalist from the AFR, which is the back page. And then we have our AGMs, so please stay. But for me, I have to make sure that we're finished by lunch, and then we have a turnaround, and hopefully you'll come back in to listen to Mike, Jacob, and Jeff. So without further ado, this is a disclaimer. So we're not giving advice, and I'm just going to echo what Kate said earlier. So we're here today to really talk about Future Generation and the model. It's incredibly unique. I'm not sure how many of you know where it came from, but it was Jeff Wilson, our founder, and he went to London. He read an article in the Financial Times about how a number of fund managers, hedge fund managers, private equity guys, had come together to raise an awful lot of money for breast cancer. And they did, and the way they did it was to manage money without any fees, and that was forever. So Jeff looked at that model and decided that Australia could do it better. So he came back and he spoke to a number of other fund managers, David Paradise, Regal, obviously Jacob, and a number of others, and they all said, we can do this as well. So they basically agreed to manage shareholder money, your money, free of charge, no management fees and no performance fees. And with that, we can give 1% to not-for-profits, young Australians that need help. So today, I'm delighted to have Lucy on the panel with me. So Lucy is one of our new partners in Future Generation Global, and she runs an amazing organization. She's the co-founder of Project Rocket. And Project Rocket really helps young people in schools overcome bullying. And she is a leader in this field. She's basically advising Facebook, Google, a number of others, and she's going to tell you a little bit more about that. But we're also incredibly lucky to have Jacob from Antipodes today. He co-founded Antipodes, and I love the name because I love what it actually represents, which I'm going to ask Jacob about as well. And he is probably one of the best global fund managers in Australia at the moment. And you're going to see with some of the answers of his questions how he really looks at a very pragmatic value approach to the stocks he's picking in his portfolio. And he'll talk about the number of stocks he has in his portfolio and what sectors they're in. So before we actually go to Jacob, somebody asked me what Future Generation really represents to me. And what it represents to me is the ability to do a lot of good while also making sure that all the shareholders get investment returns and they can actually choose what not-for-profits they want to fund. And I think that's an amazing choice. I think in the community today, when we have Jeff as chair of FGG and we have Mike Baird as chair of FGX, this is really what drives them. And I hope it drives you as well, both that unique model that provides you investment and social returns. So I'm going to go to Jacob now. Jacob, I mean, you obviously set up Antipodes a while ago. So tell me, we've heard this morning from some of the other portfolio managers really what's happening globally, what's happening with markets. You know, you've got wars, the volatility, inflation. And I think what we're all worried about is the cost of living. So tell me, what are you seeing out there at the moment?
Yeah, thanks, Caroline. Thanks for the very kind words of introduction. And you know, we've always seen it as a real privilege to be involved with future generations. So we're really are very thankful for that opportunity.
We're delighted. Without you, we couldn't do it.
And we, when we think about the world, like we've sort of lived through some fairly unprecedented times, and we still think the range of outcomes is very wide. You can see the situation where some of the supply chain, a lot of the supply chain, cost pressures are starting to unwind. And in the US, arguably, a lot of those, some of the rental pressures are starting to unwind as well as the housing market softens. So I think, the Fed, our biggest concern is really that the Federal Reserve, the central bank in the US, is actually setting policy through the rear view mirror. And this obsession with point-in-time inflation means that they are actually probably too tight. And we can explore that a little bit further, but I think that's probably the biggest issue facing investors today, to the extent that they're exposed to the US. And then if the rest of the world, you have different issues. Arguably, if you break it down to 3 regions, the US is the big economy. We also have Europe and China, a very big economy. And Chinese policy is going in the opposite direction to the developed world, to the US. And we've never seen such divergence in policy settings as we see it today. And so that means there's a real dispersion in macro outcomes, a real dispersion in sector outcomes, a real dispersion in stock outcomes. Probably, in summary, it's a great environment for active stock picking.
So with everything going on in the world, how are you actually looking how it's going to impact your portfolio? Like, how are you choosing your stocks? I mean, the world has changed so much in the last 18 months.
Yeah, look, we certainly think it's still too early to be constructive on easing in the US. We think policy ultimately has to change. We've got policy very tight. Eventually it will start to ease. But we think it will be a easing in response to a recession. So a negative easing, not a positive easing. So we still have to price in to that recession, price in the recession to earnings. And we don't think that's happened yet. And the earnings multiple on the US is roughly 18 times. And if you think earnings will fall 10 to 15%, as we do, then you're talking about a multiple that's over 20 times PE, which is a pretty high multiple for, versus you're paying 15 times in Europe and you're paying roughly 12 times in emerging markets. So that, we are biased towards, we have an underweight to the US. We have also progressively become a bit more defensive in our selections. So selling down some of the big winners of the last couple of years, we had overweights in energy, we had overweights in materials, commodities. We've tapered that in preference for sectors like pharmaceuticals, some of the consumer staples, and also, to the extent we do have cyclicals, we're looking for a cyclical business that's started transitioning to something that's a bit more structural in its growth. And we do think governments in the West are much more fiscally active now, and they are going to use programs like spending in decarbonisation, energy transition to stabilise the economy, and that exposure to that energy transition, I think, is a good place to be. We see that as policy-supported growth, which could be a great outcome in a recession, to have something that's supported by policy.
So when you talk about your stocks, one of the things that shareholders always ask us from our pro bono fund managers is some stock picks. So maybe if you could give 2 stock picks, and then maybe sort of why you're choosing them in the world that we're in today.
Yeah, sure, Caroline. It's always great to be able to talk about stocks because often the discussion is very high level. But you know, one of the stocks or sectors that we've been constructive on, as I mentioned, is the pharmaceutical companies. So these companies are seen as sometimes like defensive stocks that you rent exposure to when markets get nervous. We think they're much better than that. And we, at this event in Melbourne last year, we were pitching Merck. And Merck, American Merck, which is the developer of the the game-changing cancer treatment Keytruda, was our pick, and it has been and continues to perform very well.
How well?
It's been one of the best performers in our portfolio, and it's been in our top 10 holding of the fund. And look, it's really because the starting multiple was right. It was a starting PE of around 12 times for a company that's continuing to grow at low double-digit type rates. And the market was sort of focused on some of the things that the market gets concerned about with pharmaceutical companies is the 10-year, you have a patent for 10 years, and sometimes you approach that cliff and you lose your exclusive, and you get generics who erode away the profit pool. But pharmaceutical companies like Merck and Sanofi have become very good at managing through those patent cliffs.
And Sanofi is the French pharma company.
Yeah, Sanofi is our biggest holding today in the portfolio, and it's sort of where Merck was 12 months ago. It's sort of on this PE of around 12 times. Investors think it's boring, but we don't see a lot of patent cliff risk, and nor do we see a lot of drug price risk. As the US is trying to deal with all this government debt it created during COVID, and we've got this impending debt ceiling. When that happens, the market all gets concerned. Oh well, are they going to cut drug prices? Well, Sanofi fortunately has very little exposure to what I would say gouging, where they're overcharging American patients for their drugs. And a third of its business has also got really interesting growth profile. It has a consumer health business, over-the-counter drugs that you buy at the pharmaceutical, at the pharmacy, which are not subject to that patent issue. They're already off patent. And it also has a really strong vaccines business. And we think it's really ripe for that re-rating. And it's a great company to own in this environment. As an example of one of these cyclical businesses that is transitioning to a much more stable structural growth is a semiconductor company, which is semiconductors are a cyclical industry. ST Micro. Now, you may not have heard of ST Micro, but it's the leading, it could be described as the European semiconductor champion. It's a leader in auto semiconductors. Why are autos interesting? Well, as you electrify and you move away from internal combustion engine to EVs, the amounts of semiconductor content in a car goes up by a factor of 10 times. So you've got exposure to something that is growing at much higher rate than the economy, and it will be less cyclical than it has been in the past. And also, critically in this environment where governments, investors are focused on supply chain risk, most of the semiconductor companies in the world offloaded all of their production to Asia, to companies like TSMC and Samsung. So they're really critically dependent on manufacturing in Taiwan, in South Korea. ST Micro made a strategic decision to keep all of its manufacturing in-house. So in this environment where geopolitical supply chain risk is on everybody's mind, they have their production close to home. They have it in Europe, and we think that's worth a much higher multiple today than, say, 12 times.
So with the French pharma company, where is it in the flu market, for instance?
So in vaccines, Sanofi is the leader in the flu vaccine market, which is a great position to be in because, as you'd appreciate, vaccines need to be updated, like the flu vaccine needs to be updated every year. So it's very hard to lose your position. They have the scale to produce all of those vaccinations, on a global scale. A third of people around the world are getting a Sanofi flu vaccine each flu season. So that's a great repeatable business. Yeah.
And with your second stock pick, do they have deals with Tesla and Apple and all the others, so you can actually see where their pipeline's coming?
Yeah, look, they are. They've got some like what you might call as marquee clients, like Tesla in EVs, and also Apple in where they provide a number of different chips for the iPhone. In the short term, that could actually be a little bit of a headwind because we don't expect handsets, and especially Apple handsets, to necessarily grow that strongly. They'll probably shrink, given we tended to upgrade a lot of our personal consumer, IT during COVID, and that will normalise. And Tesla will have its own issues, I think, just because it's getting a lot more competition. But it does have, customers outside of those two, which where it's growing its market share.
Excellent. I could talk to you for a long time. But one thing you did say on our webinar, which was quite recently, is you talked about the US in terms of regulation and policy and how it was different from so many other countries. What impact is that having on, share prices?
Yeah, policy divergence. You sort of see it at two levels. You see, like, the Federal Reserve was much more aggressive on raising rates than the European Central Bank or the Japanese Central Bank or even the Australian Central Bank, where the RBA hasn't matched the Fed raise by raise. Now, why? Well, in those markets, especially like Australia, a lot more exposure to variable rate mortgages. So the transmission is much more immediate. In the US, almost all mortgages are fixed rate, and they're fixed rate for 30 years. So they had the biggest refinancing cycle in history, where as households refinanced into 2% type mortgages, and they locked them in at very little cost for 30 years. So the Fed lifts rates, but it's not impacting it takes a long time to impact the household. It actually needs financial conditions to tighten, and when regional banks start to get into trouble, that's actually what impacts the economy, because that's sort of the. So the Fed's had to tighten to the point where it's starting to risk the stability of the system. Other central banks are probably behind the curve. We think the European Central Bank, you see inflation is still quite sticky. We'll have to continue to raise rates. And we think, so there's that sort of, let's call it ongoing conflict. And I suspect, we end somewhere in the middle. The Fed ultimately has to ease, and the European Central Bank will have to catch up. But then you have China, and China's not facing an inflation issue. China is sort of positioned arguably where the US and the Western economies were as they reopened, excess household savings, but without the inflation problem. So that's where we think we can see much more stimulus. We've already had it, and it's still coming through. And, we're relatively constructive on that, China and Asia, EM more broadly, where policy is actually pretty constructive.
Thank you. So you can see, listening to Jacob, how lucky we are to have all of our fund managers. We have 33 fund managers who manage shareholder money. And what I love about the concept is Jeff always says it's a win-win-win. And as you can see from this slide, we feel it's a win for shareholders because they get exposure to these fund managers, global and Australian, without paying any performance fees or management fees. And the other thing in terms of our social impact partners is they get the benefit of an annual investment every year of 1% of our assets. And when we give it to our not-for-profits, we give it untied, which means we give it to them because we think they actually know what to do with it best. And I think that's really important because we can measure it. And we're measuring it now. We've just started out. We have an amazing impact manager who is working with a number of specialists to measure the outcome. So just as we measure our fund managers' performance, we're going to measure with the not-for-profits how they do, so they can use those measurements for themselves, and we can actually report that back to shareholders. And then with the fund managers, you know, it's a win for you guys because you get to manage money in your main fund, and you do it so well that, you know, we reap those benefits. So thank you very much. So before we go to Lucy and then go to questions, I just wanted to say a few things about Future Generation Australia. So firstly, and as you can see from this slide, this is about really the dividends. You know, we've actually increased since inception by 8.6%, beating the benchmark with Future Generation Australia. And secondly, we have an amazing investment committee. The investment committee has various members from, you know, some of the great financial minds, and they spend hours working out how and who is going to manage shareholders' money and what percentage the fund managers actually do manage. They work out the investment philosophy, and then we talk to the fund managers on a regular basis to making sure they actually manage to what they've said they will do. And I think that's really important to mention because they all work pro bono as well. And we've had a lot of Sunday night meetings at 8 p.m. to go through what we're actually doing. So thirdly, I've got to get back. Thirdly is the increased dividends. And if I go back to Future Generation Australia, here you can see the board is incredibly determined to make sure we increase those fully franked dividends to you. From last year, it went up by 8.3%, the fully franked dividend yield 5.6%, and the grossed up dividend yield 8%. And if you look at our dividend coverage, that's something that the board is very focused on, and we've got dividend now for 4.2 years, so we can really make sure in these sort of volatile and unpredictable markets that we can actually make sure we give you that income. And then if I just go to Future Generation Global, I mean, you've heard from all morning in terms of how, you know, small caps have underperformed. And, you know, unfortunately, this has been the case across the whole market. Future Generation Global, though, the investment committee started probably really at the beginning of last year, over the sort of the last 18 months, looking at the market, what was happening, reading what they thought could happening, talking to the fund managers on a very regular basis, and we started changing the portfolio in response to those external triggers. In terms of what we did, we have 5 new fund managers. I mean, you think you've seen some of them, Holowisco. I won't go through them all, and some of them have come out. And since that, we've actually had, in the last 6 months to 6% till December, we've actually had some outperformance of 1.2% against the index, which is really promising because I think the investment committee are really committed to what they have now in that mix. And going forward, we really hope that it will basically perform as both of them should do with less volatility than the market. In terms of the dividends, I think that really does speak to themselves. I mean, a year and a half ago, we went to basically twice a year with divvies, as you can see from the slide. And this year, it's 16.7% up last year. The dividend yield is 5.9. If you gross that, that's 8.4. Dividend coverage there, we have 6.6 years. That's something, as I said, the board is very committed to making sure that that's there and that we can actually continue to sort of smooth out the returns for you. And now I'm going to go to Lucy. So Lucy is one of our new partners from Future Generation Australia, and I first started speaking to her last year ago when we put out an expressions of interest because we really wanted to help young people in the prevention and well-being space for youth mental health. And we really felt that's where we could make a really important difference from what was actually going on. If you look at the mental health spend in terms of prevention by the government, it's about 1% of the 60 billion they spend on mental health itself. So Lucy is pretty amazing. I mean, she's a co-founder, and what she's doing at the moment is really looking at sort of bullying prevention in schools. So Lucy, tell us exactly what you do at Project Rocket.
Awesome. Well, first of all, thank you so much for having me here today. Very different crowd to the crowd I usually work with, being high school students.
All of them are very, very literate in technology, though.
I'm sure
All
you
of them.
are. Actually,
every single one of them.
Am I able to do some audience interaction? I'd love to ask, could you put your hand up if you have children or have had children? Okay, keep your hand up if you have grandchildren. Okay, so good to get a test. Oh, last one is, put your hand up if you were ever a child.
Put your hand up or keep it up if you still are a child.
True. Okay, I think we might all have something in common. Project Rocket is here to realise a world where every young person is free to fulfil their potential and where kindness and respect can thrive over bullying, hate and prejudice. That's our vision. And it sounds pretty lofty, and it is actually, because it was conceived by two young people who were fresh out of school and could see the force that young people can have in changing the world for the better. Those two young people are no longer young. I'm actually one of them. And but shortly after finishing school, my little sister Ro and I started a little community project going back into schools and having conversations with teens about the issue of bullying and the role that every single one of us can play in shutting down hate. You know, all of us will have had a moment before throughout our lives where you're standing by and you see something you disagree with, but it takes a lot to overcome the social risks or physical risks in actually intervening. So what Project Rocket does, we're a youth-driven organisation that recruits and trains young people to go out into schools and have these powerful conversations. Conversations I think we probably all wish we'd had in school. And we've been around for about 17 years now, so this little community project that we started has now grown and it's reached over 500,000 young Australians. We're up to about 600,000 and counting. And we've elevated over 90 young people into career-starting employment in the social impact sector. So that's a little bit about Project Rocket.
So what are the numbers? You know, I mean, I think I know so many people that bullied at school and uni and then on. So what numbers are we actually talking about? And do people admit to being bullied?
Yeah, so the reporting rates around bullying do differ depending on the source and depending on whether it's online or offline or both, but the generally accepted stat is that 1 in 4 young people in Australia report being bullied each week. And when we started out, that was actually 1 in 6, and so you could say we've almost had a slide backwards. Although what has also changed is that we've had a huge spike in help-seeking behaviour. Yeah. So we know that the reason that these rates are actually probably a little more realistic than they were 20 years ago or 40 years ago or 60 years ago is that we've had cultural change around the importance of coming forward and accessing support. I think one of the things that's interesting about that stat as well is that if 1 in 4 young people report being bullied, then the logic flows that perhaps at least 2 or 3 in 4 saw bullying happen as well, whether that be in the classroom or after school or online. And so that's where Project Rocket intervenes. This is where we have a role to play in ensuring that each teen, each young person, each child has credible strategies and safe strategies that they can use when they see bullying happen, not just when it's happening to them.
So how do you prevent bullying? Like, what are you doing in schools? What are you doing online? And why is it so important to get it at a specific age?
Yeah, great question. There's actually really mixed evidence about the efficacy of anti-bullying programs, but there is a consensus across research that interventions that involve young people and elevate the peer group have significant results. And that kind of makes sense intuitively that, we feel we can create change if we're the ones leading our own learning. And so, yeah, peer-based approaches tend to be really effective because they ensure that young people, even by training young people, they're becoming the leaders on the issue that they're experiencing rather than just the kind of passive subjects that experience it. And so for us, it's not about singling out the bully or the victim. We've found that those labels, they can be quite dated and they can also be very hard to change. If you've been labelled in primary school, say, if you've been labelled as the victim, evidence shows that it's likely that you'll be victimised throughout your entire life, into high school and beyond, so into the workplace as well. We know that the long-term negative outcomes for people who experience childhood bullying are really significant. They also cost the workforce exorbitantly. And they range from, engagement with the justice system, family violence, mental ill health, and a whole range of other challenges. But we also know that for young people who bully, these negative impacts are actually quite similar. the long-term outcomes for those who bully and those who are bullied are actually run in parallel. And so we know that we want to give young people who haven't quite worked out yet how to manage their anger or develop effective communication skills, we want to give them the tools to be able to change. So Project Rocket works with a whole cohort, a whole year level, and the idea is that it's about shedding the social cliques and ties and labels that we may have worn before, and to look at the strategies that every single person in the room can play in making school, and indeed our whole world, a more kind and inclusive place.
That's an amazing goal. So how, with the funding that we give you from Future Generation, why is it so important to have untied funding? Because that's I think, one of the benefits from us. Like, we give it to you for 3 years on a minimum, and then we sort of try and help you work with other organisations to create more of an impact. So, I mean, what are you going to do specifically with that money, and what's your view over the next 3 to 5 years?
The opportunity to work with Future Gen for us is pure magic. When you run a grassroots organisation, honestly, your head is so in the weeds, and there's always something that feels very urgent to attend to, whether that be the spike in mental ill health of young Australians or the realities of running a youth-driven business. And what this kind of funding does, what untied funding does for us, is allows us to pull our heads out of the mixing bowl and be strategic about our growth and be clever, and not be pulled in the direction of one-off grants or commercial realities, especially during COVID. Selling business into schools has been incredibly challenging. So it allows us to consolidate. It allows us to invest in things like capacity building, which are incredibly important for a youth-led organisation like ours. And for us, our aim as a result of this funding is to reach 1 million young Australians by 2025. Before this partnership was announced, for us that was kind of a big, hairy, strategic goal, and now it's a reality. So that's the kind of game changer that funding like this can make for us.
I think that is incredibly exciting. I think for all of us, that we can actually make such an impactful, result, hopefully, with you. So one thing that I'm really interested in, because I do have a 15-year-old, is the metaverse. And I remember you speaking at an event recently and talking about what you were doing with virtual reality goggles.
Yeah.
So what's actually happening with all these large companies that can actually help, overcome bullying?
Sure. So we're experiencing a real metamorphosis when it comes to technology and social media. And if you cast your memory back to the mid-90s, so it's 1995, we all turn on the computer that's plugged into the wall. We access the internet via a dial-up connection, and we type a URL into the browser, and we read content. Fast forward to now, we hold a device in our hand. We're constantly creating. We can create videos. We can call people. We can stream entertainment in real time. Fast forward 10 years, and the metaverse is I think, the kind of system or paradigm that we're looking at. The metaverse, in contrast to these previous two ideas of the internet, will be much more immersive. There'll no longer be a difference between our online and our offline, and through the use of wearables like our watches, our glasses, VR goggles, we'll be able to layer a completely new reality that's designed by not only engineers but everyday people like you and I onto our own. And so there are a whole range of opportunities and challenges and weaknesses and threats. There we go. We're going to do a SWOT analysis of the metaverse for this future paradigm of technology. And right now there's a whole heap of conversation, primarily led by Meta. Facebook did change their name to Meta, highlighting how important this new space is going to be.
And you're one of the global advisors.
Yeah, so we work very closely, in particular with Meta, but as well with other social media platforms, to look at how they can get ahead of some of the challenges of our current state of the internet to actually create a space that's more kind of egalitarian, more imbued with those Western democratic values that corporations like Meta kind of want to see realised through technology as well. So yeah, it's a really exciting and interesting time, and we've just led a large-scale youth consultation project across Australia, kind of capturing a report on young people's ideas for the metaverse so that it's actually led with their top concerns and priorities in mind.
Excellent, thank you. Now, are there any questions for Lucy or for Jacob? We'll also have time afterwards after the AFR panel for questions and also the AGM. So do we have any questions? In that case, I'm actually going to wrap up, and I'm just going to point out this slide because I have to thank, oh, I've got one question. Excellent.
Lucy, can you tell us, do you think bullying is very much worse now than it ever was in the past? Has something gone wrong with humans, that they're all bullying each other, or is it just given a lot more attention than ever it was before? And is there a lack of discipline, perhaps enabling more people to do more bullying in schools?
Great question. I think the world has revolved around its axis many times, and bullying has been flipped in the process. That what we're seeing now, as opposed to when I grew up or when other folks in this room grew up, is that bullying is now 24/7. With the advent of smartphones and devices, we now don't have an issue that ends when the school day ends. So in some regard, you could say that the issue's changed. It's no longer a confined school issue. It's something that happens at all hours of the day in the home, and so therein it's created many more concerns and dramas for parents. But at the same time, one of the things I'd say about this emerging generation is because of that access to technology, they also have access to many wider worldviews, to current affairs. They're much more literate when it comes to matters of diversity and kind of different cultures and perspectives as well. So I'd say what we're seeing is, in some ways it's more, but in some ways it's actually really changed, and this generation is more inclusive and able to galvanise movements of kindness using technology as well. I'm sorry I don't have a simple answer for you. I'd say in some ways it's gotten worse, but in other ways, and this is probably the hopeful view that I can leave with you, is working with teens every day, you really can see their literacy, their striving, and their desire to create a world where people are genuinely included for who they are.
Thank you, great question. Thank you very much, Jacob. Thank you very much, Lucy. And also thank you to all of our fund managers that work pro bono, our investment committee and our boards. And we have 24 not-for-profits who benefit from that 1% across both of the companies. But thank you very much for coming. Lunch, I know I'm competing with lunch. So lunch is now to the right and to the left as well. And then we'll be coming back in maybe 15 minutes, and you'll have Mike Baird, Jacob, and James Thompson with Jeff Wilson. Thank you very much.
Okay, well, welcome back from the most important part of the day, that's lunch, to the second most important part of the day, this Future Generation panel. My name's James Thompson. I'm a Chanticleer columnist at the Financial Review, and I'm really pleased to be here to host a great panel. Jeff needs no introduction, the founder of WAM, and of course the founder of the Future Gen concept. Is that a good way of putting it?
Well, I copied the concept from a guy in the UK, but in Australia.
Right.
Exactly.
I set it up to make you look smart, and you didn't help me at all. Jacob Mitchell is the CEO and founder of Antipodes, a fund manager based here in Sydney, and Mike Baird is the chairman of Future Generation, and he had a few other jobs too that you might remember him from. A former Premier of the state, of course, and former executive at NAB, and also currently the CEO of Hammond Care, one of the largest aged care providers in Australia, I guess, Mike. Yeah. So I'd like to start, Jacob, I might start with you. It's been quite an extraordinary 12 months on markets. How do you reflect on where we've been and where we sort of end up at the start of 2023, hanging on to what is a quite unlikely share market rally?
Yeah, look, it's a good question. I suppose it's been an exceptional 12 months, but you could say it's been an exceptional 3 or 4 years. Yeah. Like something has happened on a pretty regular basis. And maybe if we just go back to, we think we're living through a period of what we call fiscal activism, and it's a response to, growing populism across Western economies. And if you cast your mind back to when Trump was elected and we had tax cuts in the US at full employment, and that, it was quite unprecedented and a big switch to the sorts of austerity programs that we'd had prior to that. And since then, we've seen more of that, and we think we're just living in an environment where you've had a permanent shift. And governments are much more reactive, and they're going to use fiscal stimulus. Even with high levels of debt, they're going to use fiscal stimulus a lot more than they have in the past. And the central banks are sort of being captive, becoming captive to governments. They're slowly losing their independence. And we think, you know, we were set up in the last 12 months for an environment where inflation stayed relatively sticky, you know, higher for longer, and, you know, the Antipodes global funds, you know, have done well against that sort of backdrop.
Yeah, yeah. So, Jacob, where do you think inflation goes from here? It's still pretty sticky. Higher for longer looks a fair bet, but it's moderating now. So what does the next 12 months look like?
Yeah, look, we think it will moderate pretty quickly, and then it could actually start to really disappoint on the downside, right? Because, and you know, we're actually set up for an environment where the swings in inflation and the swings in economic growth are much wider than they have been in the past. So, yeah, we would say sort of strap in for a fairly exciting period, because the tightening that we've seen from the US Federal Reserve is somewhat unprecedented in terms of the accelerated nature of it. You know, if you think, cast your minds back 12 months ago, policy rates were, you know, 0, and now 5%. That's a massive shift in a very short period of time, and that will impact inflation. We're really tightened things up. Inflation's coming down fast. If there's one part of inflation that stays sticky, it's that service element, that element that's more sensitive to domestic wage or domestic employment conditions, because domestic employment conditions in the US are staying pretty tight.
Yeah. Yes. Jeff, you're obviously quite old. No.
Only because I've lost my hair.
No. I didn't mean that. You're a very experienced investor. Have you seen a period like the last 12 months? Is there any cues from your career that you've been able to use over the last 12 months to say, here's how this might roll out, or here's how what I'm seeing does rhyme with the past?
Yeah, I'm finding it hard with the rhymes, and it's interesting how in terms of when I started the market in 1980, and I remember, you know, in those early days, and you know, the comment Jacob was making, you know, we might go back to, you know, shorter business cycles. But back in those days, it was longer. In theory, we'd gone from shorter to potentially longer business cycles. Yeah. From one of the things that has really surprised me is, and you know, we'd seen, say, a 30-year bull market in interest rates. You know, interest rates close to 0. You know, obviously very positive for valuations. You know, we benefited. Anyone who's invested in the stock market up until the last couple of years with that. And then, and even stories, you know, around people, you know, whose children had invested in Bitcoin and turned, you know, a few $1,000s into 30, 40, 50,000. You know, there's all those stories. And you know that what happens, and I remember in my early days, I worked for a fund manager, then worked for a stockbroker. The first broker I worked for, you know, one of the senior guys said, Jeff, you'll make your money in your second bull market. And I was thinking, what does that mean? And I understood what he meant when I lost everything I thought I'd made in my first bull market. And in your second bull market, you've learned a bit, and you know, you understand to take some off the top. So there's a natural cleansing, which I thought we would have had by now.
Yeah.
And you know, the Australian market isn't even in a bear market.
Yes.
in this. So you know, we had the extremes. You know, we've had interest rates go up because of inflation, etc. But we really haven't had the pain. And either it's a new world, but whenever we say it's a new world, we know it's not.
Yeah.
Or the pain's still coming. Or, you know, as I mean, one of the interesting things is monetary authorities, in terms of what they've learnt, you know, from the GFC, in terms of how quickly they respond in pumping money into the system to keep, you know, the system moving. You know, to me, that is, you know, that's been something that they've really, you know, accelerated the use of that, of liquidity.
Yeah, yeah.
So whether that gets us through, I'm still a little bit, and maybe it's because of my age, and because I've seen the '87 crash, and I've seen the Asian crisis. I've seen a lot of the pain. I would still be keeping a reasonable amount of cash.
Fair enough.
Just on the sidelines, but in theory, you've got to be in the market.
Yep, fair enough.
Yep.
Mike, FutureGen has a wide variety of stock pickers on its roster, lots of different styles. How have you seen the last 12 months through their eyes?
Well, I mean, I think Jeff spoke at an event when he had the advice come back, and they gave him advice that could either go up or down. They're very, they were right, actually. No, look, I think for me, I stay at the macros. What I don't sort of understand, and there are detailed practitioners in the market every day, but at a macro level, you've seen the cost of capital go up. We've got the likelihood of global recession go up, yet the stock market's still moving up.
Yeah.
Now, that doesn't add up to me at a very macro level. So I think, and you also have the geopolitical over the top. The geopolitical uncertainty is real, and whether the social unrest that could come into place like you'd never seen at the US, coupled with the likelihood of a US default. I mean, I think the CDSs are the highest they have been today or now. So you've got this very strange position at a sort of global level, and at a specific US, which has been such a powerhouse. It's one thing, when are they going to pay the debt back and how? I mean, yes, they can raise the ceiling, but that's not a solution long term. So how does that play out? So to see the stock market where it is with that overlay, to me, I would sort of tend to caution, and I think that position of a cautionary approach with a reasonable level of cash would be a position I've taken. Certainly echo Jeff's words on that.
Yeah. To Jacob's point, Mike, on the demands or expectations on government to come in and, put the fire out, save the ship every time. How have you seen that change? I mean, I guess in a way it's a pandemic era thing, but it probably has its roots a little bit further back than that.
Well, I think there's been a laziness, and I think the laziness goes back to a reliance on monetary policy. Governments actually have fiscal policy, and they have a responsibility alongside that. The concept of budget repair, I used to remember those days that actually used to be a thing.
Yes.
I think whether it be the US, whether it be Australia, I mean, we've still got a relatively low level of debt on a GDP basis, so that's strong. But that doesn't mean you just keep going upwards. I mean, that's just future taxes somehow being spent. Some debt is good debt, but we're in an unsustainable level kind of globally. So, I hope that governments start to act on that and are prepared. Governments are prepared to do things today that might not necessarily benefit them electorally, but actually it's for good of nation.
Yeah.
And I actually think, perversely, that leads itself to good politics. Good policy is good politics, is my strong view.
Yeah.
But there's been a resistance, and I think, we're paying a price in various countries for that.
I was thinking, Mike, as I prepared for today's panel, that which career might you be missing more? The political career, given what happened in the New South Wales election, or the banking career, given what's happened in the banking sector in the last few months? Have you got any reflections on SVB and Silicon Valley Bank and what's going on there?
Look, aged care's great.
I'm getting to that too, don't worry.
No, well, look, I mean, that's... you saw many people say this is not, what we've seen previously, and the derivative position, the lack of capital, was prevalent then, much less so now. So there are controls and provisions that have protected it, but it shows you how vulnerable it can be, and there was obviously interventions required, and the moment you lose confidence in the financial system, the knock-on impacts are significant. So, look, I think it's, in this country, our banks are incredibly strong, and they're not immune, but certainly they should give some comfort to us. And the reforms that have come in post the global financial crisis, I think, put us in a much stronger position. But, they're not immune to sovereign defaults, and, the list goes on. So stronger, but still open to risk.
Yeah. Jacob, what did you make of that episode, and how does it fit into your view of the sort of new regime?
Yeah, look, we still think the banking crisis in the US is actually still playing out. It's not over yet. And, you know, it really is just a simple observation that, you know, you put rates up aggressively. In the US, banks don't fund, you know, the mainstream mortgage market. That's disintermediated out of the banking sector. And those mortgages get turned into bonds and they get turned into fixed rate bonds. So the US is quite unique in that if you put up funding rates, there's roughly 60% of all the lending that banks do is long-term fixed rate. So the banks don't have the ability to lift. They can't pass on those funding pressures. And ultimately, they have to reprice their deposits, or, you know, those deposits will find themselves into money market. You know, in the US, you have a very deep money market industry which earns the Fed fund rate, right? You can go to a money market fund and earn 5%. Why do you have your deposit with Bank of America earning 0? Or, you know, the average deposit yield for the majority of the big banks in the US is about 1.5%. So we expect deposits to continue to leave the system and go into relatively risk-free money market funds. And as that happens, it will really tighten up credit conditions, and the weaker banks will be found out because they have to start reducing their portfolios, and you know, they realise losses as they do that. So we think three implications. The return on equity in the US banking system is coming down. So you don't pay the multiples that you have in the past for US banks. Number two, the lending conditions are really tightening fast, and regional banks are really important to sectors like commercial real estate, roughly supplying about 40% of lending to that sector. So we think the commercial real estate market remains under a fair amount of funding pressure. And number three, if you think about this as a short-term interest rate shock, in the US private asset market, where there's been a lot of growth, a lot of allocations from pensions to private equity, private equity gets funded off the leveraged loan market, and the leveraged loan market does reprice in real time. So a lot of the private equity who are owners of businesses are getting a shock to their funding, and we don't think that's yet really played out from a, you know, let's call it from a system perspective.
Jeff, a bit of breaking news for the audience. We had our latest CPI results today, and inflation's coming down a little bit, so from 7.8% last quarter to 7% at the headline level, and the trimmed mean has come down from 6.9% to 6%. Where are you on the Australian inflation? I know, I think Matt Hapt talked earlier about he sees rates sort of remaining steady for the rest of the year. What are you feeling in terms of inflation in Australia and where that sends rates locally?
Yeah, I remember years ago in my old broking days, we got Bernie Fraser in for lunch. Actually, I suppose that was when you could get, you know, the Reserve Bank governors.
Don't do that today, yeah.
and it was, you know, we had sort of a dozen fund managers there, and this is when I think inflation was, you know, 6 or 7%. And he got us all to write down on a piece of paper what we all thought inflation was.
Yep.
And then we systematically called out our number, and he spent the lunch convincing us that we're all wrong. And what it made me realise is, that it's that expectation. If everyone expects there to be inflation, there'll be inflation.
Yep.
Yeah, obviously there's been some. I mean, that's relatively good news. I'm still, I don't think we're going to get to the inflation, down to the levels that, the twos and that over in the US and here, people are talking about. So what
the targets?
Yeah, exactly. Yeah, the targets. So what worries me is that inflation, it will come down, but it'll still end up being a bit higher. Because I think, we've got a whole generation that hasn't lived with inflation. But now it is living with inflation, and I get the feeling people are accepting it. I know it's painful, but people are accepting it. So I'm not that bullish.
So we haven't seen any unanchoring of expectations so far, with people sort of But you're a bit worried
that we won't get down to where as low as...
And perhaps as inflation we get more used to it, then expectations could change a little.
Well, and it just keeps it at a higher level.
Yeah.
That's what worries me.
Some of that could come down to some of the mega trends, I guess, that we're looking at. Jacob, I know you've looked a little bit at AI and the power there. We saw Microsoft and Google deliver quite solid tech results today. On the Google call, they mentioned AI 53 times, I'm told. And I listened to the Microsoft call, it was a similar number. This is the hottest trend in the investment markets at the moment. How are you seeing that, AI's potential?
Yeah, look, it's going to be, I think, in a very boring way, it's going to be adopted by the biggest companies in the market. So large cap tech has a competitive advantage for the foreseeable future because they have very large data sets. And those, if you take a company like Alphabet or Google or Meta, they know about what our purchasing intent is, they know our social networks. And then you take a company like Microsoft or SAP or Oracle, and they have these massive corporate data sets. And then they have all the compute muscle to be able to crunch and see the patterns and do all the machine learning to work out the information, who their most important customers are, what you're likely to do next. And so look, it's really playing to the strength of the existing, large cap leaders. Yeah. And the question is, once again, from an investing perspective, are these companies attractive investments? Now, their biggest profit pools are still their existing businesses. So, digital advertising in the case of Alphabet, Azure, and Microsoft software. So it's a question of what multiple you're paying for businesses that are going to, yes, they'll adopt these tools, and they're in a great position to adopt them and offer them back to us as services, but that's going to happen over a period of time, and it will take a long time before it becomes material to profitability. And you might also see more competition between that group, because Google will need to fend off. Microsoft wants to move into search through ChatGPT. Wants to out Google. So these two companies get more serious about competition.
Jacob, I know you've been thinking a bit about the Apple share price. I think Microsoft and Apple are now easily the most created trades in the world. Those two companies are like 13% of the US market just by themselves. Quite extraordinary. How do you think about the crowdedness of those? Is there room on the bandwagon still?
Yeah, look, I mean, the mention earlier about the rebound in the stock market, it has been very narrow. It's been driven by quite a few companies, and the largest cap companies have performed or outperformed on this bounce. And I think Apple is now the largest company as a percent of the S&P as a record.
Yeah.
And look, we own Microsoft, we don't own Apple. Look, we were somewhat concerned that Apple's business model, whilst it has services, it's still very dependent on the gross profits that they earn out of the hardware. 70% of profits are coming from selling a device. And look, we think Western consumers are starting to get the cost of living pressures, even with inflation falling, there's a lag effect of repricing interest rates. We're really only just starting to see it in the Australian context where these fixed rate mortgages are rolling off. And we see that in other markets as well. So we think the consumer, we're not really super keen to pay. Apple's trading on the highest relative multiple in its history, let's call it last couple of decades from its resurgence as a company. And yeah, we're not keen to pay that for a company that's very sensitive to consumer spending.
Fair enough. Mike, if I could ask you about another demographic, another mega trend, and that's demographics. Obviously hugely important in the aged care game in two ways: customers, but also staff and labour and the cost base. How are you seeing that play out? From everything we see about aged care, it seems that the labour challenge is still huge.
Yeah. No, it is, James. And before I get that, just adding on the AI. The interesting thing. We're a relatively small player in the corporate landscape. Relatively large in the aged care landscape, but we're looking at AI, And there is AI where residents in our facilities, you watch them day in, day out, and you get an indication on usual behaviours, normal behaviours, and then if there's a variation, I mean, there's a whole algorithms that go into it to kind of anticipate potential falls or changes in acuity. That's like a potential game changer. And, so we're relatively small. So AI from top to bottom is going to have a huge impact. Even our complaints, you get them written by AI, and they're better than I can write them. Well, that's not saying something, actually, but they're incredibly. It's incredibly impressive, and the opportunities are huge. But the workforce challenges are, it's unlike anything I've seen. I mean, I'm pretty much Jeff's vintage, so I've kind of seen most things, but I've never seen a workforce crisis like this, and the impact is huge, particularly in a care. Because if you're providing care, the thing that most people connect with is that individual carer, and that is where the deep relationship is born, and that's where you actually understand. You don't need AI. If you've got a carer there, they'll know the behaviours, they'll know that something's not quite right.
Yeah.
So to have attrition across the sector going up to 60%, 65%, at the peak to have 25% of your workforce unavailable because they had COVID or had been exposed to COVID, and that brings in agency staff, which is cost. It brings in overtime. But can you keep providing the quality care? And that's the challenge. The good news is it is smoothing. So in terms of the sector, the challenges they're not coming to an end, but they're certainly, I would say, more manageable. We've seen attrition come down. We've seen agency costs come down. And in the long term, this government has committed to additional funding in terms of carers and nurses. So there's additional resources coming, and there's a bit of a hope at the other end of the hill. So it's been tough, but it's probably best described as easing a bit.
No, that's good to hear. Jeff, you're of course irreplaceable, but could you ever foresee a time when AI could help your investment team in some way?
Well, I mean, it was interesting because when we were on our roadshow, and I think when we were in Canberra on Monday, the AI question was asked. And I was sitting at one end and I had the lead portfolio managers there. And I was thinking, maybe I don't need to have them.
I hope they're not here now.
That was just a quick thought.
Right, okay,
that was just a quick thought.
Yeah.
And they're probably thinking the other way. They're probably thinking, maybe we don't need him.
Yeah.
So that's right. It'll be fascinating to see.
But when you think could it help analyse historical data, pick out patterns?
I mean, all that stuff. Yeah, but like that already happened.
Yes.
True. And you got, but obviously that can improve.
Yeah.
I mean, to me, it depends where you think your competitive advantage is, isn't it?
Yes.
And to me, the interesting thing is, like, when you sit down with the managing director and have a discussion, you actually, you watch the body language. So it's all those other bits of information.
Indeed.
That you sort of put together in the mosaic to give you the answer.
Yeah, that's
now,
right.
Is that the right answer? Who knows? But it is.
It's hard to replace that intuition, isn't it? Yeah.
Well, yeah, but it'll be interesting to see how that develops. And
yes.
Like as everyone said, I think everyone's thinking. Actually, Jacob, that's right. What are you in funds management? Are you?
Yeah, look, I think
get rid of all your animals. No.
I think the AI working with the analyst who has a good balance of the IQ and the RQ, the rational quotient, is pretty powerful. Like the two working together are quite powerful. I mean, that's how we're approaching it at Antipodes. But I definitely agree with Mike in terms of it. It's probably can deflate some of that service, like knowledge workers, actually creatives. I mean, the generative nature of this AI, in terms of creating content, feeding information in and getting it summarised.
Easy, Jacob. That's what journalists do.
Hey. So does that mean Chanticleer?
You could just
we'll just have an AI chook.
Yeah, that's exactly right. You'll have a boss hosting this panel next year. That'll be fine. I am going to get some stock tips out of our panellists, but we do have time for one quick question from the audience if we've got one. Otherwise, we're going to go straight to stock tips. Oh, I think we've got one way over on the right.
Right.
I don't know if it's really a question, but Mike Baird brought up a very good point about the concerns of the employment level and the fact that there's not enough workers out there. Could it be, if this is the question, that we've been guilty of taking people out of the workforce by firstly not allowing kids to leave school at year 10 and pick up a trade, year 12 encouraging people to go to university to do courses on absolutely anything, where, just speaking for myself, whilst I was doing study part-time, all my learning was in an office. And in an office environment, I was the one student and I had 7 or 8 people in that office teaching me, and now we have, kids who are students till what, they're 24. Everyone thinks the solution to fixing employment is bringing people in from overseas. I just think that kids could grow up quicker. I certainly grew up a lot more joining the workforce as opposed to hanging around kids at school, and I do classify university as school. Is that potentially where the system's gone wrong in the last 10 years? Thanks.
Yes, Mike. Training in aged care, I imagine you're throwing everything you can at it.
Yeah, no, we are. But I hadn't even thought about it that way. That's a really interesting perspective, because there are a lot of kids in year 11 or 12. It's that concept, we have to get to year 12, that really school's not for them. There was a young care worker I saw who volunteered for us at school, and the moment she left school, she came to become a care worker. And I saw her, on the floor in action, and it was just beautiful. Like, she cared deeply for the residents. She was desperate to learn, how the dementia training. She was dementia palliative training. She was someone that you want every care worker to be like. I think part of it, so certainly that's a pathway. To me, how many people think that aged care, as a care worker, is a great career? You hear the really tough stories which have dominated the Royal Commission. I think part of us is changing a little bit from a societal point of view. There is deep value in looking after our elderly. There is deep purpose in the day-to-day. You can change people's lives, and I've seen it. I've seen people's lives changed. We hold up various professions, and if you think of the aged care sector, it feels difficult. How are we holding it up when I've got care workers right now in dementia cottages, some challenging behaviours undoubtedly evolving, and they're getting paid $22 an hour. Like, that's not right. So, and they're starting to move the wages, but I think if the more students understood the difference you can make to someone's life, I think that's an opportunity. And we've got a partnership with the University of Sydney. I'm going to talk to 4,000 nurses. I'm going to say, look, everyone thinks you should go into an emergency department, but what about aged care? There's a whole managerial career that comes about, and a whole range of diversity. So certainly the pathways you spoke about, I think that's something, but it's changing the national conversation and working with government to promote it. Wages is one thing, but actually the value of the work, I think, is another.
Thank you, Mike. Well, I know Mike Baird's stock tip's going to be Future Generation Global. Is that right?
Australia.
That's right.
Yes.
Great.
Yes.
Australia, sorry.
Yeah.
So we don't need to stock tip from you, because we know exactly where your heart lies. We're up against a hard stop. Jacob and Jeff, you've got a minute to pitch us your stock tip. Jacob, we'll start with you.
Really quickly, just three stocks. The first one is a company called Siemens Energy, which is a leading manufacturer of wind turbines, high transmission grid equipment, and gas turbines. And basically, it's the one-stop shop for the energy transition. Just extending Mike's view. Really, what we're seeing here is just not so much labour shortage as skills mismatch. We've started this investment cycle that's very capital intensive. It's not the digital. The digital one, we've sort of been on that pathway for a while, and we've got a big productivity dividend. The energy transition is about building things. You need electrical engineers, electricians, you need lines people, And we don't have those skills in the developed world. We're fundamentally short the labour we need for a super cycle, which is not solving for productivity, it's solving for risk. Right? And so we think it will be more inflationary, so it is part of that regime change. Siemens Energy's one-stop shop to play that multi-decade cycle, and it's on a multiple that doesn't, you're on a low multiple relative to the amount of growth that we see coming. Number two, stock I mentioned earlier is also tied into that, ST Micro with EVs. And then finally, we like, from an AI perspective, whilst we've got exposure to some of the software companies that are going to benefit from that, like Microsoft, Oracle, SAP, you also want to be owning, let's call it the arms dealer to those companies, and that's TSMC. So it's the company that makes the GPUs that you need to power all the AI machine learning. And instead of paying like a really high growth multiple, like an NVIDIA, which is let's call it the owner of some of the GPU IP, that stock will trade on 50 times. TSMC is available on, more like 15 times.
Great.
Right, and I suppose with, my backdrop, not quite, being a bit uncertain with the, where the market will go, I've sort of gone for the buy $1 for 80 cents logic. One of them is global data centres, GDC.
Right.
They're broadly trade around $1.45, $1.50, $1.93 of NTA. You could argue it's higher than that. They've basically put up a white flag and they're going to sell it and give the money back. So that'll, you'll get a return over the next couple of years. And the other one is, again, discount asset plays. You can argue the assets are worth $1.70, $1.80. It's AMP. And if AMP, I think, don't deliver this time, you looked at their vote at the AGM.
Yep.
It was 49% against the REM, 51. So the shareholders, we think the CEO can deliver. Whether the board helps it to deliver, the guns are there. So if they don't, they're the two. And just quickly, I know we're just on time, but my comment about being a bit nervous about what will happen going forward is, when you invest in the market, there's a book I had a look at the other day, and it talked about the US market over the last 20 years. And I think if you looked at the market performance over that period, it averaged about 7 or 8% per annum. Yeah. If you didn't invest in the market just one day each year, so the best day each year, so that's 20 days, your performance over that period was 0. So it's that old...
Stay invested.
Stay in.
Yep.
Yeah, stay in.
Yep. Well, that's a great note to finish on. Ladies and gentlemen, will you please thank our fantastic panel.